Okay, we're beginning a long reading. I want to prepare you for that. It's a long reading, and it seems overly detailed for being just tucked away in economics. But it just needs a lot of explanation to get to a few key points. So it looks long. It's gonna be long, but at the heart of it, there's not a lot there. So, anyways, currency exchange rates, determination, and forecasting. And that title might throw you, forecasting. I thought, coming off of time series analysis, it was told to us in that reading several times that currencies are a random walk, and sometimes a random walk would drift. Now we're going to talk about forecasting. Well, when we get to it, we're going to see that we revisit that problem of random walks. So when we talk about forecasting, it's over what time period are you talking about? So the first few learning objectives really is a repeat of level 1 with a little bit more clarity on what was going on. So I hope to spend a little bit longer on there because, listen, if you get confused about the idea between the price currency and the base currency, and especially the foreign and domestic, that's a big problem. That's just not necessary, and you don't need to know it. It just is convenient for something, and I'll explain that when we get there. So I'm going to go slow through the first little bit just to make sure you're with me so that later on when we get to asking questions about which currency needs to do what, you don't have to stop and try to think, well, hang on a second, which one are we talking about now? It'll be pretty obvious. So the chapter uses, there are two quoting conventions for currencies. The chapter uses this one exclusively, price over base, as a ratio, the price over the base currency. The other way of writing it is B.P, base.price, which is the more common quoting convention. At least it's the most common quoting convention when you're actually in the market dealing with currencies. I've never seen a trading platform anywhere give me this kind of quoting convention, P over B. I think that's really just for the textbooks and the academics. So I'm going to try as best I can whenever there's P.B to give it to you in B.P. So let's have a look at a real example just so that we can understand what's going on here. The typical quote you'll see in the market is US.CAD. And how we read that is the first currency is the base currency. The second one is the price, B.P. And it's easy to remember. Everything builds off of a base, right? So the base is always first. Also, B comes before P. B over before P, base price. So the base currency is always 1 unit. 1 unit. The price currency is exactly how many units of the price currency you have to give to get 1 unit of the base currency. So in this case, US.CAD equals 1.3410. If you want 1 US dollar, you've got to hand over $1.34 Canadian, 1.341 Canadian to get $1 US. If you have $1 US, you can buy 1.3410 Canadian. So your dollar, basically, the base currency is always $1, tells you how much of the price currency you can buy. We can think of it the other way as, what is the price of a US dollar? And this is the price currency. This is CAD. It could be Aussie, it could be New Zealand, it could be anything. But what's the price I'm looking at in Canadian dollars? What's the price of 1 US dollar? $1.34.1 Canadian. If it's written in this form, instead of US.CAD, it's CAD over USD, and that can start to be confusing. So I want you to think about it this way. The base becomes the base. The base currency becomes the base of the ratio. It's at the base of the ratio. Base and bottom both start with B. Base, bottom. So here we have 1.3410, and we read it the same way. What's the denominator of every currency pair? The denominator is always 1. It is always 1, which means the numerator must be 1.3410. So it's 1.341 over 1, saying that 1 US dollar will buy $1.34.1 Canadian, or if you have 1.341 Canadian, you can get a US dollar. So B comes before P. base, price. And if you need to express it in this formula, B and bottom start with the same word. I'm not going to say denominator. It's at the bottom of the ratio, B, base, bottom. So here, now we have to, now that we got that straight, we got to figure out, well, which direction is long and which direction is short? And what are we doing when we're long and when we're short? So if we're long, we're buying the base by paying the price. If we're short, we're selling the base and receiving the price. So every transaction happens on the base. If you go long, it's the base. If you go short, it's the base. So have a look at the US.CAD and let's go long in both these scenarios and see if we can't figure out what we're doing. If we go long, it's the same as if we bought a stock. Let's say the stock is 20 bucks. If we go long, what are we hoping for? Well, we're going to pay 20 and hope that the price goes up. Then we're going to sell the stock for the higher price, right? Well, it's the same with the currency. It's 1.3410. If we want to go long the base, which is the US dollar, we will buy 1.3410. We will buy and hope that it goes up. So what are we doing when we hope that it goes up? Let's think about that. Well, I've parted with 1.3410 Canadian and I've got myself a US dollar. When I convert that US dollar back into Canadian, I'd like to have more than 1.3410. I'd like to have 1.4, 1.5. Do you get that? So if it goes to 1.4, 1.5, what has happened? The US dollar bought 1.3410. Later on, it can buy even more of the Canadian, which means the US dollar has strengthened. So if we're going long by buying and hoping that the price goes up, we're hoping that the base currency goes up, or alternatively, we're hoping that the price currency drops. I don't care which one happens. I don't care if I made money because the Canadian dropped, and I don't care if I made money because the US dropped. All I care about is my long position paid off. So we buy $1 US by paying $1.34 Canadian. We now own $1 US. We hope that that US dollar gets more valuable in Canadian funds. So in essence, we are two things here. We are long the US dollar, but we're also implicitly short the Canadian. So when I go long at 1.3410, if I say I'm short the Canadian, it's true. I am short the Canadian, but because currencies are traded in pairs, if I'm short one, I must be long the other. I'm long the US, so I must be short the Canadian. And that's why I say I'm long the US, so if it strengthens, great. I'm short the Canadian, so if it weakens, great. Now you may say, but isn't that the same thing? Aren't you saying the same thing? No. A catalyst could come in that strengthens the US dollar, and this will go up. The Canadian, you might say, but that weakens the Canadian. But listen, the Canadian could hold its ground against every other currency, but only depreciate against the US dollar. That's the US dollar getting stronger. Or the Canadian could weaken, which means the US dollar, compared to every other currency, is not even moving. It's not even budging. It's not even changing value. The Canadian is weakening. So long the US, short the Canadian. Anything that pushes the US up or pushes the Canadian down, I win on. Let's short it now. I am spending some time on this. If you're thinking, okay, I get this. Trust me, let's spend some time on it. Make sure we understand it. Let's say we're short. Everything we do, long or short, always deals with the base. We're always dealing with the base. So here, I'm going to sell the base and receive the price. So if I short it at 134.10, what I'm implicitly hoping for here is that the price drops down. Well, how's that going to happen? Well, I'm selling the base and I'm receiving the price. So now I own 1.3410 Canadian. Here I owned $1 US. Now I own 1.3410 Canadian. I paid the dollar US and I got 1.3410 Canadian. I'm hoping that at some future price I can buy that US dollar back for less than 1.3410. So I'm hoping that this price goes down. It's the same as shorting a stock. If the stock is 20 bucks and you're betting on it going down, if you short it, you're betting on it going down. If you short this, you're betting on it going down. What gets confusing is, well, if it goes down, what's going on here? Well, remember, everything we do is on the base. If I short this, I'm shorting the US dollar. In other words, I am implicitly long the Canadian. So I own Canadian, 1.3410, and I hope that of this money that I have, I can go back and buy back my US dollar for less than 1.3410. Let's say I can buy it back for 1.30. Well, then I make 0.0410 in Canadian dollars just for my troubles, right? So that means that I'm now short the US. It also means I'm implicitly long the Canadian. So in this scenario, the US dollar can weaken, I'm happy, or the Canadian can strengthen, I'm happy. Either one of these two things can happen. So remember now, there are two quoting conventions. B.P, base.price. B comes before P. If you want to put it in this format, all you do is you bring B to the bottom, which means P must be at the top. B and bottom are the same thing. Whether we go long, whether we go short, it's always on the base. It is always on the base. All right, let's get into the structure of the currency markets a little bit more. Settlement on any spot transaction, T+2, that's settlement. Typically, as soon as you, whatever system you're trading on, as soon as you click anything, your broker or whoever you're going through pretty much segregates those funds right away. As far as your eyes are concerned, it's gone instantly. But in behind the curtain, if you move back the curtain, you can see that it settles in T+2 days. So the the currency market is a 24-hour-a-day market, which opens sometime Sunday in the afternoon. Now you're probably saying, what do you mean sometime Sunday in the afternoon? Can't you give me a time? It depends on the broker and what time they give you access to the interbank market, or what time your dealer decides to bring the interbank market online for you. Trades can start as early as 3 o'clock in the afternoon, beginning with the opening of Wellington, New Zealand. Typically, it's 5 o'clock or 6 o'clock, depending on who your broker is. Typically 5 o'clock Sunday night, and it doesn't close. Till Friday night at 5 p.m. And how it works is there's an interbank market where currencies are traded, and there'll be dealers, and dealers will be have access to the bid and the offer from the interbank market. Then the dealer has clients, and the dealer provides a bid and an offer to the client, but widens it. So we'll go through all of this in a second. I just want you to understand there's three layers here. There's an interbank market, there's a dealer that deals in the interbank market and provides the bid and the offer for the client. So let's just go through what the bid and the offer mean, and we'll do it from the client's perspective, the dealer and the client here. The bid, let's say we're looking at the Euro US. This is a current bid and offer on the Euro US. Or if you want to write it this way, remember B comes before P. So B becomes the base, which is the bottom. So Euro.US would be US over Euro. So let's say that I, the client, am seeing a bid of 105.17 and an offer of 105.20. What does this mean? Well, 105.17 means the dealer is willing to buy Euro for 1.0517 US, and the dealer is willing to sell euros for 105.20 US. So if I want 1 euro, remember now, as we price this out, the base is always 1. If I want 1 euro, I must give the dealer 1.052 US dollars. If I have a euro and I want to sell it, I will get 1.0517 US dollars. Now notice that the spread is wider. So this is what happens. Let's say that I sell my euro to the dealer for 1.0517. The dealer will then go to the interbank market and sell it for 1.0518. See what they did? The dealer bought it for 1.7, will sell it for 1.8. I sold it to the dealer then sells it in the interbank market. That's why the spread is wider for the client, because the dealer has their bids and offers from the interbank market that are much tighter, and they can lay that off right away. So the client sells euro for 1.0517 US. That's called hitting the bid. As soon as I do that, the dealer then transfers it to the interbank market and sells it for 105.18. Notice that they bought it for 1.7 and now they're selling it for 1.8. So they make a profit just on you trading. Over here, see, the dealer is willing to sell for 105.20. So let's say that you pay 105.20 US for a euro. That's called paying the offer. Let's say you pay that. The dealer will then turn around and buy it for 105.19. So you sold it, the dealer sold it to you for 20, but maybe didn't have it, sold it to you for 20, then immediately buys it for 19. It's the same as being short, right? You're selling at 20, you're covering at 19. So because the interbank market spread is thin and the client spread's a little wider, the dealer makes money on every transaction. Now, let me say something about this. The spread here depends on something, and it depends on the type of dealer you have, that sometimes you do not have this wider spread. Sometimes this bid and this offer from the interbank is given right to the client. The client is then trading at the interbank rates, not dealer rates. But there's a catch with that, and we'll see that very shortly. So the spread, as I ended on the last screen, the spread depends on a few things. And one thing, the one thing the book doesn't mention, I'll mention right at the end, but I'll go through what the book has first. Depends on the currency pair involved. There are major pairs and there are cross pairs. Major pairs: Euro US, US Yen, the Sterling US, and there are four other big ones. The Swiss is in there as well, and of course I've written them out in both conventions here. Notice that Euro US, again following the B.P. Over here we've got P.B. So you can check for yourself that they all follow suit. These are major pairs. They're major currencies, they're major pairs, very deep and liquid pairs. So you get very tight spreads on these, sometimes 1 pip. And if you're actually getting the interbank market quotes, the closest you're going to get is half a pip. So you'll get as little as half a pip. I shouldn't say the closest you'll get. Sometimes you can get closer than that. But typically the closest I've ever seen is half a pip. Cross pairs. Cross pairs are currencies that are not major currencies, and then they're just simply cross. So the Swiss is a major pair, but the peso is not. So this is the Swiss peso, this is the peso yen, and of course I put it in the other convention as well. Since these are cross pairs and not major pairs, there's very little trading between the peso and the Swiss franc. As far as from an institutional perspective, there's probably very little going on there. Probably same with Mexico and Japan, very little. So you get wider spreads on the cross pairs. Your major pairs will have tight spreads. Your cross pairs will have wider spreads. There's the first thing that the spread depends on. Number two, it's the time of day. During very busy peak times, the spreads tighten up. During lulls or quiet times, the spreads widen. And there are three big markets, or at least three big time zones for currencies. The Japanese opening, the European opening. This is about 8 o'clock. And it doesn't really, there's about 8 to 11. And it really deals, you get a lot more liquidity in things like the yen, the New Zealand dollar, and the Aussie dollar. But you're still on the North American dollars, like the Canadian dollar, the peso, and some of the European currencies, still very wide spreads. The European Open, 3 o'clock. Then the spreads on most of the European currencies really start to tighten. And then North America opens up. Typically, traders start coming into the game around 6 in the morning, about by 7:30, 8 o'clock. You've got very, very tight spreads, and that'll last all the way to about 11:30. So you can see exactly the times that they come on. This is London time, and the time is not important. What is important, we'll just follow along with Tokyo here. At 9 in the morning, when the markets are really flying open, it's midnight in London. It's 7 o'clock at night, the night before. In New York, 7 o'clock at night. So everything is really close. So there's not a lot of liquidity in here. But by the time we get to 1 o'clock in Tokyo, you're 4 o'clock in London. It's still only 4 in the morning. It's 11 o'clock here. You'd pretty much have to get to 8 o'clock London time. There we are here. But Japan is now gone. That's now 5 o'clock. And it's only 3 o'clock in the morning in New York. But by the time you get to noon in London, notice it's 7 in the morning in New York. So right to about, this is all the way to 4 o'clock. This is 11 o'clock. Right to, I'd say, somewhere in between here. Right around 11:30. The spreads widen slightly. By the time in New York you get to 3:34 in the afternoon, the spreads are still very close, but they're not as tight as they were in this morning period. Once you get past 4 or 5 o'clock, then you start looking towards the Japanese Open. So you have the Japanese Open, then you'll have the European Open, and then you'll have the North American Open, and these two overlap. There's where your most liquid period will be. Third reason for the spread, or third cause for different spreads, volatility, especially right in front of a major data release. So if you're watching non-farm payrolls in the U.S., it's the first Friday of every month, non-farm payrolls, and it is 8:30 a.m. New York time. And if you watch, if you're a currency trader, by the time you get to 8:29 and about 50 seconds, about 10 seconds before the release, let's say you're looking at the Euro US, and it's a particularly critical jobs report, you might have, just previous to that, like 30 seconds before that, you might have a 1 pip spread. Well, that spread can easily widen to about 20 pips, about 10 seconds before the release. Once the release hits, it happens very quick. The adjustment happens very quick. That 15 seconds later, at 8:30 and 45 seconds, at that 15 seconds, the damage is done. If you had to get out, it was too late. That's how long it takes. At about 15 seconds after this spread starts to decrease. By the time you're about a minute after, you're back to about 1 pip. It happens very fast. But just in front of a major data release, those spreads really blow out, because nobody wants to take a position in front of that much uncertainty, and the dealer doesn't want to do it either. So the dealer widens those spreads and says, listen, if anyone's coming in, I'm making money on this, period. If anyone wants to get out, I'm making money. And finally, your bid-ask spread also depends on who the broker-dealer is. I say broker-dealer, but who your broker or who your dealer is. Some will pass on the interbank bids and asks, but charge a 1 pip commission. This is Interactive Brokers. And I'm not sure if I like it or if I hate it. Sometimes I like it, sometimes I don't. But you get the interbank quotes, but every time you trade, you're going to pay 1 pip in commission. So if you trade $100,000, it's going to cost you $10 in, $10 out. If you trade $1 million, it's going to cost you 100 in, 100 out. So that's a $200 round trip trade on $1 million. Some will spread the interbank bid ask but charge no commission. So some will just give you a wider spread on them. Here's where I like paying the commission versus getting a free trade, is because when they spread the bid and the ask, I don't know if they're getting me for 2 pips versus what I could get here. Here's what I do know. In times of data releases, Interactive Brokers, the spread will widen. But and they charge the commission on whatever you buy, but the spreads will widen. Some that don't charge you the commission but widen the spread will do this. Suddenly it'll be that much bigger. But typically what I've seen is when I'm looking at another dealer's spreads versus IB, if IB has a 1 pip spread, other dealers have a 2 to 4 pip spread. So now I'm paying significantly more. Here I know I'm paying 1 pip in, 1 pip out. I know that. I know I'm going to pay something. The dealer's going to make something. Here I know what it is up front. So be careful with that. Some of your dealers, whoever you deal with, may pass on the interbank rates and you pay the 1 pip commission. If you're comfortable with that, off you go. Others will just widen the spread and you don't know what commission you're paying for. The other thing that you got to watch for in your broker is, let's say that, and I'm just going to make up to a couple of numbers here, 1.4563, 1.4570. Let's say that's the bid and that's the offer. If I don't like either one of them, with some brokers, I can enter in a new bid or a new offer and it will print in the market. I then create a new market. Some brokers, if you put this in, it holds the order. Let's say it was a sell order. It holds it until the market moves and hits it. So that you're not actually creating a market. You're going to take the market. It's the same as putting a limit sell order in. You're not actually going to get, even though you're in the middle of the spread, it doesn't actually print in the market. They don't bring you to that level of the market. They don't bring you to printing. They just say, well, you're going to take our rates. That's what you want. You're going to wait till our rate hits you. and some you can actually create the market. So shop around for your broker when it comes to currency trading, because those ins and outs and the distance on the spread, they can add up to some significant dollars, especially if you start trading 3, 4, 500,000 at a time, or $1 million, $2 million. When I was active, I was trading 5 million in, 5 million out. So those were big commissions. I didn't want the unknown spread on that. All right, we're on to LOSB. Keywords here are identify and calculate. What are we doing here? Identify a triangular arbitrage opportunity and calculate its profit given the bid offer quotations for 3 currencies. And this is where in classes I've lost people, because it can get it's not difficult, it's just confusing. You get confused between what's going on. So I'm going to try to keep it all straight for you here. Dealer bid offer quotes must respect 2 arbitrage constraints. We're going to look at 2. Number 1 is easy. Number 2 is called triangular arbitrage, which is what we're going to get to. But let's look at this one first here. The dealer's bid must be less than the interbank's offer, and the dealer's offer must be greater than the interbank bid. So it always helps when there's numbers, because when there's numbers, you could say, oh, okay, I see what's going on. So let's say that we have an interbank, the interbank market is giving us a quote of 105, 1.0522, 1.0524. Let's say that that's the Euro-US pair, Euro being the base, US being the price. Doesn't matter what it is, I'm just trying to make a point here. 1.0522, 1.0524. And let's say the dealer then offers these quotes. Now, the dealer's supposed to widen them, which means the bid should be lower than the interbank bid, the offer should be higher than the interbank offer. But let's say the dealer messes up and offers this. Notice now that the dealer's bid is higher than the interbank's offer. The dealer bid should be less than the interbank offer. Here it's higher. What's going to happen is another dealer can look at this and say, I can sell to this dealer at 25 and buy here at 24. Or I could buy in the interbank at 24 and sell it to this guy for 25. Buy at 24, sell at 25. Buy at 24, sell till it disappears. So there's an arbitrage opportunity, because the dealer is not following this particular constraint where their bid should be less than the offer. And I think you can look at it the other way and follow the logic, create a situation. The dealer offer should be greater than the interbank bid. Otherwise, you have arbitrage on the other side. Triangular arbitrage. A dealer cross-rate bid, because now we're dealing with 2 currencies, so we got to look at a cross rate. A dealer cross-rate bid must be less than the implied interbank cross-rate offer. Notice up here, dealer bid must be less than the interbank offer. Here, the dealer cross-rate bid must be less than the interbank cross-rate offer, but we have this word implied. What does that mean, implied? Well, here's what it means. If I have 2 currencies, and I have quotes for 2 currencies, if I have bids and offers for 2 currencies, from that I can imply what the cross rate would be. Otherwise, it'd be an arbitrage opportunity. So here we go. So if we have these 2 quotes, US over Euro and Yen over US, which in the other convention looks like this, US.Euro.US and US USD.Yen. I say Yen, JPY. I don't feel like saying JPY. I just call it Yen. Because we have these 2, we can imply JPY over EUR, or the Euro.Yen. Why? Look what we can do. If we cross out the US on this, what are we left with? Yen over Euro, Yen over Euro. And what's in the bottom? That's our base. So whatever quote we get, it'll be in terms of how much yen we need to buy 1 euro, or how much yen we will get by selling 1 euro, right? So let's put some numbers to this and have some fun here. Let's say the Euro.US, or US over Euro, looks like this, 105.22 and 105.24. There's the bid and there's the offer on the Euro-US. Here's the bid and the offer on the US.Yen, 118.1, 118.15, the bid and the offer. To get the cross rate bid and offer, it's really, really easy. We take the offer on the first pair and multiply it by the offer on the second pair. That'll give us the offer on the cross rate. We take the bid on the first pair, multiply it by the bid on the second pair, and that'll give us the cross rate bid. So all we do is we just observe our two currencies, multiply the two bids, multiply the two offers, and that gives us our bid and our offer. So what is the cross pair bid and offer that must hold? Otherwise, there'll be triangular arbitrage. Well, the bid, 1.0522, multiplied by 118.1 will give us 124.26. That becomes the bid in the cross pair. And the offer is 105.24 multiplied by 118.15 gives us 124.34. That becomes the offer on the cross pair. Multiply the two offers to get the offer, multiply the two bids to get the bid. As long as the currencies cancel out, you'll notice that US cancel out, and all we do, we can say we have these two rates. You can change this and to a multiply. We just multiply the two rates, and it's just like multiplying fractions. These two cancel out, and what are we left with? We're left with the yen over the euro. So let's just look at a general approach. And what I've got here, C, B, C, the ABCs, this is not base or anything like that. That's just the letter ABC, A standing for a particular currency, B for another currency, and C for another. So if we have A over B and C over A, so this was US over Euro, yen over US, notice that the A's here cancel out. What are we left with? C over B. To get a cross rate bid, we take the bid on the first pair and we multiply it by the bid on the second pair. That'll give us the bid for the cross pair. To get the offer for the cross pair, we take the offer of the first pair multiplied by the offer of the second pair. That'll give us the offer of the cross pair. We just did that. This is just in sort of a general form. If you like this notation better, B dot C equals B dot A times A dot C, the two inside and the two outsides. So the two insides cancel out, and then you have the two outsides, so it would have B dot C, B dot C. And so you can sort of play with some paper, rearrange it, and see that it comes out with you come up with the same thing. As long as the two inside ones are the same, they can cancel out, and you end up with B dot A. We're going to see what happens when we have three currencies, but they don't satisfy this. It's A over B times A over C. Well, what do? The two A's are in the numerator. We got a problem. We can fix it, but we're going to see that next. So to get the bid on this, it's the bid of the first pair multiplied by the bid of the second pair. To get the offer of the cross pair, it's the offer of the first pair multiplied by the offer of the second. Notice that this is saying the same thing. It's just I'm using different terminology. Just so that you see both terminologies and you're able to jump back and forth between the two. All right. What about this? A over B and A over C. And you have to find C over B. You have A over B and A over C. Now you got to find C over B. Well, that's easy enough. We need C over B. A over B is in the right form because B is already in the denominator. We need B in the denominator. Here, we need to invert this. We want C in the numerator and A in the denominator. So we invert. But when we invert, the bid and the offer on this gets all messed up. The bid in this form becomes the offer in the inverted form. So the offer becomes 1 divided by this the bid, and the bid now becomes 1 divided by the offer. So going from A over C to C over A, whatever the bid and the offer is for A over C, we'll take the offer. 1 divided by the offer will be this one's bid. We'll take the bid, 1 divided by the bid will now be the offer for this one. So the offer is 1 over the bid is 1 over the offer. Let's actually look at some numbers. They always look better with numbers, I think. Let me get a nice color pen here. So let's say that we have the US over the sterling, and here US over euro. Notice that the US is in the numerator on both. And if you want it in the other convention, there it is there. I'm eventually going to drop this other convention. I'm going to keep hammering it to you until you're used to seeing it, that you can move back and forth between the two currency conventions. But I'm eventually going to drop it and just stick with this. So let's say that here's the bid and the offer on this pair. Here's the bid and the offer on this pair. But we want to find this cross pair. Well, the sterling is in the denominator here. Euro's in the denominator. That becomes difficult to do. So we have to invert one. Well, the easiest thing to do is say, well, we need euro in the denominator. Euro's already in the denominator here. Let's not touch this. Let's just invert this one. So we want to invert the US sterling here. So our bid for this cross pair is 1 divided by the offer. And so it's 1 over 1.5646, 1.5646. So our new bid on the cross pair here, or sorry, on the inverted ratio, is 0.63914. Our offer is 1 divided by the bid, 1.5644. We get 0.63922. The offer should be higher than the bid. 922 is higher than 914. Great. So we inverted this. Now we're ready to calculate the cross pair. So we need the bid. The bid is, you just multiply the bids on both. So what is the bid here? 0.63914 multiplied by 1.3649. There's the bid of the cross pair. And for the offer, we just multiply the offer of both. 0.63922 and 1.3651 gives us 0.8726. The offer should be higher than the bid. It is. There we go. So let's do a few more examples just to make sure we got this straight. Here are 4 currency pairs. Bases are all in the denominator. The price currency are all in the numerators. Notice that I'm not writing it out on the other convention now. And here's the bid and the offer for all the 4 pairs. Number 1, what is the bid and the offer for the SEK, by the way, is Sweden, for the Swedish krona to the euro? Well, do we have SEK anywhere? We do, and it's in the numerator. We need it in the numerator, so this is perfect the way it is. Do we have something with euro in the denominator? We do over here. And US is on the opposite side of both, so that works out fine. The US will cancel in both ones. It'll cancel here, and we'll be left with SEK over EUR, which is what we need. So that's just straightforward. To get the bid for this one, we just multiply the bids of both of these. So we'll multiply 6.8739 by 1.4559. We get 10.0077. And to get the offer, we just multiply the 2 offers. 6.8741 multiplied by 1.4561 is 10.0094. Nice and easy, right? What's the bid and offer for yen over CAD? Well, where's our yen? Here it is. Do we have Canadian anywhere? There we go. And they're both versus the US, so that's great. But we have a problem because the US is the base on both, and the yen and the CAD are both price. We need one to be inverted. But which one? Well, we need the yen over the CAD. Here it's the yen over the US, so let's leave it there. The yen's already in the numerator. Here it's CAD over US. Let's invert this one. And we'll have US over CAD. The 2 US's will cancel, and we'll get what we want. So step number 1, invert CAD.US. How do we do it? Well, the new bid, the bid for CAD US is 1 divided by the offer. 1 divided by 9546. There's our new bid. And our new offer is 1 divided by the bid. 1 over 0.9544. There's our new offer. Now we're ready to just multiply the 2. So what do we need? We need the yen US, and now we have our other bid and offer over here. So to get the bid on the yen Canadian, we will multiply both bids. 1.04756 multiplied by 81.87. And there is our bid. And to get our offer, we'll multiply 1.04778 by, what's our offer here? 81.89, 85.80. Next question. If the yen to Canadian were quoted at 85.73 to 85.75 by a dealer, triangular arbitrage would include doing what? Well, we've already come up with the bid and the ask here, 85.76 to 85.80. There's a dealer that has 85.73 to 85.75. So let's see what we can do. The 75 is below the 76. We have an offer that is below the bid. So what are we going to do? Well, we're going to buy Canadian from a dealer at 85.75. If the dealer's quoting this, this is the bid, this is the offer, which means if we're doing something, we must buy. This is selling, this is buying. We'll buy for 85.75, and then up here, we can sell for 85.76. Buy CAD from the dealer at 85.75, sell CAD intermarket for 85.76. There's the 85.76. So this dealer is messing up. What about a dealer quoting 85.74 and 85.81? Anything that can be done there? Well, the 85.81 is greater than the 85.80. so we can't do anything on the offer. What about the bid? 85.74 is less than the 85.76, so we can't do anything on the bid. There's no money to be made here. No triangular arbitrage on that one. All right, we're on LOSC. Now, keywords here: distinguish and calculate. Distinguish between spot and forward rates and calculate the forward premium or discount for a given currency. We've seen this in level 1. We've seen a little bit of this in level 2 derivatives. This really should be a repeat, but we'll go through the steps. Forward exchange rates must satisfy an arbitrage relationship. We know that they have to. Futures prices are priced based on an arbitrage argument. So for convenience sake, let me say a word about this. I want to be absolutely clear on this. We've been quoting the currencies on a convention: P over B, price over base, B, base, bottom, there we go, price over base. Well, now let's call it F over D for foreign over domestic, because now we have to make a distinction between the foreign currency interest rate and the domestic currency interest rate. This is just a convenience. There is no rule, there is no law saying that a base currency is your domestic currency. A base currency will be regarded as a domestic currency in quotes, but there's no rule that says it must be your domestic currency. Let me give you an example just so that we're clear. When we call a currency a base currency, it's really just in line with the notation. It's a convenience. It's not a rule. So, over here, I'm in Canada. My domestic currency is the CAD. There we go. But what if I'm trading US Euro? Which one is foreign? They're both foreign to me. That's F over F. They're both foreign. So if I were trading US over Euro, and let's say instead of going long, now I'm going short, which one's the foreign currency? Which one is the domestic currency? If you asked me that, I'd look at them and I'd say, they're both foreign currencies to me. In fact, every currency in the world except mine is a foreign currency. Every currency in the world is a foreign currency. So I have to have some way of determining, well, which one will I call the domestic currency? And typically we call the base the domestic currency. The base is the domestic currency. How do we remember that? Easy. We're really, really rich. We have servants. Where do they live? We have domestic help. Where do they live? They live in the basement. So in the basement is the domestic help. Think about it that way. So in the basement, base and basement and bottom all start with the same letter. In the basement live the domestic help. If you can remember that, I try to come up with something interesting and funny so that you remember it. In the basement live the domestic help, B for basement, and it has the word base right in there. In the basement lives the domestic help. It is a convenience because no matter what country you live in, you only have one domestic currency. Every other currency is foreign. All right, so let's go. So let's say that we have 1 unit of a domestic currency. Whatever that domestic currency is, we have 1 unit of domestic currency. We can do 2 things. We can invest at the domestic risk-free rate, and that will denote by I sub D. So I sub D is the domestic risk-free rate. We can invest our unit of D at that rate. We will have 1 plus ID at the end of the year. That's our end of year payoff, 1 plus whatever the interest rate is. Or we can convert to the foreign currency at whatever the spot rate is. S, F over D. F over D is the foreign over domestic, which is price over base. You can substitute price over base back in here. The only reason we switch to foreign and domestic is because it's hard to keep remembering. We want to see the word foreign and the word domestic because it's easier for us to get as opposed to seeing P over B and having to stop and go, okay, now hang on. B is what now? B's domestic, P is foreign. That's it. Instead of saying that, it's just a convenience. It's just a convenience. Please understand that we're just doing it to save a cognitive step. All right? So we are going to convert. We're going to take our unit of D, convert it to F, the foreign currency at whatever the spot rate is, and invest at the foreign risk-free rate, which is I sub F. So in 1 year, we will have SFD multiplied by 1 plus the foreign rate. What is F? This is the spot rate. So that's our domestic currency expressed in terms of whatever the spot rate was, multiplied by the interest rate. Then we will convert all of that back to the domestic currency at whatever the forward rate is 1 year out, F sub FD. So we have the spot, S for spot, F for forward. So what do we have? We have, this is how much money we have, and we're going to divide it by whatever the forward rate is, and that'll put it back into the domestic currency. But this is messy to work with mathematically, so let's rip it apart. Here is our numerator, and instead of having it divided by FD, we're just going to multiply by 1 over the forward rate. 1 over the forward rate, because we're going to do some mathematical work on this later. But for yourself, you can satisfy yourself that this part of the equation is exactly this part of the equation. We've just pulled this out. Well, guess what? These two have to be equal. If they're not equal, then there's an opportunity to borrow money and do one thing and enter a forward rate to do an exchange later on. There's an arbitrage opportunity. They must be equal for there to be no arbitrage opportunity. Okay, so let's. This is the statement I just made on the other page. Whichever direction we go, the domestic or the foreign, they must be equal. They must equal each other. The risk-free rates, the I sub D and the I sub F, the risk-free rates quoted typically are LIBOR rates. So let's introduce the day count convention into this to make it a little bit uglier, but I just want to do it step by step. So we have these LIBOR rates, so let's put the day count convention in so we don't get messed up. So it's 1 plus the domestic rate multiplied by, of course, its day count convention. Notice that all I'm doing is I'm just multiplying the rate by its day count convention. That's all I've done here. And let's simplify this by multiplying through by this. If we multiply through by this, and then we're going to divide through by that. And this is what it simplifies to. The forward rate is the spot rate multiplied by the ratio of the two currencies, the foreign. The rate on the foreign currency over the rate on the domestic currency, of course, both sized or scaled for the day count convention. This equation is called the covered interest rate parity, or covered interest rate parity. It's important to recognize that covered interest rate parity must hold. It holds. If it doesn't, there's an arbitrage opportunity and it will be arbed away. Covered interest rate parity holds. Later on, we're going to drop the covered and introduce something called uncovered interest rate parity. That does not hold, but covered must hold. It's not a question of if it holds. It must hold. It does hold. So the learning objective said to calculate the forward premium or discount. This is the forward rate. So how do we get the forward premium or discount? Well, with a little bit of algebraic manipulation, we can get to something like this. The forward rate minus the spot rate. There's your forward premium or discount. The forward rate minus the spot rate is equal to the spot rate multiplied by this term. Notice we still have the same denominator over here, but we've lost the part of the numerator. We have the day count convention. And coming to the outside, what is that? That's the interest rate differential. So the forward premium or discount is, depending whether we're going to have a premium or discount, is entirely dictated by the interest rate differential. Because the spot, this term here, will always be positive. This term here will always be positive. This term here will only be positive if the foreign rate is higher than the domestic rate. Then you'll have a premium. But if the domestic rate is greater than the foreign rate, this term turns negative. Now you're going to have a discount. So we can sort of start to see a relationship between the premium or the discount based on the interest rate differential between the foreign and domestic. And it's F minus D, and the interest rate, the foreign rate minus the domestic rate. Now, you'll notice this is page 8B, and you may be thinking, we just left page 8 and this is 8B. I haven't seen an A, B, or C on your pages before. What's going, does it mean anything? Yes, it does. Sometimes when I write out my black screens, I forget to save them before I move on to the next one. Then I realize that I completely missed a screen. Well, I've already numbered them all. So what do I do now? I can't go back and renumber every screen. So what I do is I say, well, this goes in between page 8 and page 9, so I'll just call it page 8B. So if you're wondering, does page 8B mean anything? Is there a message in there? Is there buried treasure somewhere and he's showing me the way? No, I just missed a page. So this is what I ended the last screen by saying. The domestic currency will trade at a forward premium, and that's what a forward premium looks like. The forward rate is greater than the spot rate if the rate on the foreign currency is greater than the domestic currency. Remember that last term was IF minus ID. So if the foreign interest rate is greater than the domestic interest rate, this last term is positive, it will then add to everything. It will make the whole other side of the equation positive. That's it down here, right here. It'll make this whole thing positive so that F minus S will be some positive number. You'll have a premium. And it will trade at a discount if the foreign rate is less than the domestic rate, because then this term will be negative, making this whole thing negative, which means the forward minus the spot, the spread, will have a negative sign in front of it, being a discount. Now, let's put FD back into PB. Notice that these are all PBs now. I think we get the idea of foreign and domestic. So let's put it back into the PB. So this is where we left off on the last formula for the futures price. And this is the calculation. This is the formula we would use to calculate the forward premium or the discount. Let's go through an example and let's see how absolutely easy it is. I've said this before. I'll say it again. Your formulas are your maps. If you're ever lost in a city and you don't know where to go, what do? You take out the map and you trust the map. Well, if you're ever lost in a question, you're looking at it going, okay, so where do I start? Look at what's being asked. Say, okay, well, I know what the formula for that is. Then just trust the formula, fill in the terms. So let's say our spot rate, CAD.Aussie, is 1.0145. 270-day LIBOR in Australia is 4.87. 270-day LIBOR in Canada is 1.41. What is the forward premium or discount? And you're looking at this going, oh, okay, hang on now. How would I even start? Just remember the formula. The forward premium or discount is the forward rate minus the spot rate. Well, we're told what the spot rate is. It's 1.0145. We need to just to figure out this whole term. So it is all of this. So do we have the spot rate? We do, 1.0145. We don't have to figure that out. Actual over 360. What's our actual? Well, it's 270-day LIBOR, so it's 270 over 360 over 1 plus the domestic. This is the base. The base, who lives in the basement? The domestic help live in the basement, so the base is domestic. What's the domestic rate? 1.41. Sorry, the base here is Aussie, AUD. Sorry, I got that wrong. Our base, it's CAD over Aussie. So our base is 4.87, 0.0487, and then we know our day count convention is 270 over 360. And then it's the price minus the base. Well, we know that our P is the CAD, our B is Aussie, so it is 0.0141. That's the foreign. Minus 0.0487, that's the domestic. So just looking at this last term, are we going to have a premium or a discount? Will this term be positive or negative? This term will be negative, which means this whole term will be negative because the first term will always be positive. Everything in here will always be positive. This determines everything. So I know right away we have a discount. So once I multiply it out, I certainly do have a discount. All right, here we're going to introduce something called forward points. We already know how to calculate the forward premium or discount, and forward contracts for currencies are quoted in terms of a spot rate plus points. So we're typically given a spot rate. Now I notice I say here, you have this same chart in your reading. I'm pointing out a possible mistake over here. How do I know this is a mistake? I'm looking at this. What makes me think that I'm looking at a mistake? Some of you who have currency experience will recognize it right away and say, oh yeah, that's got to be a mistake. Well, this is the spot on the US over Euro, which is the Euro.US, which is an extremely liquid currency. 135.49 to 136.51. That is a spread of 102 pips. 102. That's got to be wrong. Either this is 1.3649 to 1.3651, or this is 13549 to 13551, but I'm going to leave it as the 6. So you notice that I'm going to do some calculations. I'm going to leave it as the 6 because that's what it is, but I'm pointing out that that's a possible mistake because you'd never get a spread that was 1 cent wide, 102 pips. That's every 100 pips is a penny. You'd never get a spread that wide in currency, so that's a possible mistake. So if you're looking at that going, what's going on there? Yeah, that's a print mistake, but I don't know if that should be a 5 or if that should be a 6, but I'm just going to leave it because it's not important for what we're doing. So you'll typically be given a spot quote, plus these are all of the points. So if we want to know what a 6 month, I gave the example here of a 1 month. If we want to know what the 1 month forward rates are, the bid and the offer on the 1 month forward, all we do is we subtract the points off of the spot. And the 5.6 comes right off the 9. So you can consider this 9 and this is 5. So how would we do it? 1.3549 minus the 5.6. Wherever the decimal is, it lines up with the end of the currency. Minus 5.6 is 135,434, and then we'd take 5.1 off of the bid. Now notice this ends in 51. This is 5.1. You can't just subtract it. The 5 lines up with the 1 like this. 1.3651 minus 5.1. So if we're given the points, if we're given the spot, and we're given the points for a whole bunch of standard forward dates, these are here 1, 3, 6, 12. These are standard forward dates that are typically quoted, these points. We can figure out what the forward bid and ask is, or bid and offer is on any of these. Now these are pretty much standard forward dates that are typically quoted. Clients can select any time period. Remember, these are forwards, so these are OTC. These are not futures, they're forwards. So they can select any time period. If they select something non-standard, it's called broken, a broken forward as opposed to a standard forward date. Here I say forward FX rates are quoted in terms of points. I've already made that point. I just saw some writing and I didn't refer to it. The longer the term, the wider the bid offer spread. Notice how as we move from 1 month to 3 to 6 to 12, the bid offer spread widens and it will be wider. Why? Because the further out you go, liquidity declines. Counterparty credit risk increases. Remember, this is OTC now, so there isn't a clearinghouse here. It's OTC, so you do have counterparty risk. And interest rate risk increases. On 1 month, if there's no central bank meeting on any of the two currencies, we don't have to worry about interest rate risk. But going out 12 months, there's 6 or 8 meetings of the Fed in the U.S., and I think there's 10 or 12 of European Commission. I'm not really, I can't really remember them off the top of my head. I know it's every 6 weeks for the Fed, and I forget how often it is for the ECB. So you have interest rate risk. That increases as well. So that's a nice little primer on how to read the spot with forward points. Okay, we're on our next learning objective now, LOSD. LOSD is to calculate, and we are going to calculate, where are we here? The mark-to-market value of a forward contract. All right, we know what mark-to-market is, so I don't need to explain that, but let's do it with the forward currency contract, because it can be confusing because, again, currencies are traded in pairs. It's not just one single thing, right? So the value of any contract at initiation will be 0. And the mark-to-market value changes as, of course, the underlying changes. What's the underlying? The underlying is the spot. And what can also cause the underlying to change? The interest rates. And as interest rates change, whether it be on the foreign currency, the price currency, or whether it be on the domestic currency, the base currency. So let's have a look at a scenario. Let's say at time 0, here's a timeline 0, 3 months, and 6 months. At time 0, we entered into a 6-month forward. We bought 10 million pounds at an exchange rate of 1.61 for the Australian dollar. So we bought 10 million forward at this exchange rate, 1.61. This means we will pay 16.1 million Australian in 6 months because we bought 10 million pounds forward at this exchange rate in Australian. That's the price of £1 in Australian dollars. We need 161 Australian to buy £1. We're going to buy 10 million of them, so we'll need to part with 16.1 million Australian in 6 months. Let's say that in 3 months we want to close the position. We still have 3 months left in the forward contract, but at the 3-month time point we want to close the position. The current spot rate, the bid and offer, 162.10 to 162.15. That's currently what we can observe in the spot market for this pair. So what do we have to do to close the contract? Well, like we do with any other derivative contract, we take an offsetting position. So if this were gold and we bought a gold forward for 6-month delivery, how do we close it? By selling gold forward at this point for 3-month delivery. We got to sell it for the same time period, right? So if we bought 10 million pounds for 6-month delivery, if we want out here, we have to sell 10 million pounds for 3-month delivery. I hope you see that. We bought 10, so we must sell 10. The 10 million pounds will cancel out. What will be left? It'll just be the difference in the exchange rate in Australian dollars. So clearly our payoff will be in what currency? Or our gain or our loss at this point will be in what currency? If the 10 million pounds here and the 10 million pounds here cancel out, what's left? Australian dollars, right? So we know that whatever answer we get will be in Australian dollars. So we want to close the position. We must sell 10 million pounds 3 months forward at whatever the spot rate is today. So we must sell. We're here. I want to be clear on this. We entered into a contract here for 6-month delivery. We want to close it here. We have to enter into a contract for 3-month delivery so that the 10 million pounds cancel each other out at this point in time. So the 3-month points are 130 and 140. Remember, we said that forwards are quoted based on a spot rate plus points. So we look down a chart, we find our 3-month points, and they're 130 to 140. Great. So what we have to do is we have to determine the forward bid. Remember, the forward bid is the spot plus the points. So it is the forward bid, since we are selling 10 million pounds, we sell on a bid, we buy on an offer, so we know we're using 162.10 because we have to sell. So 162.10 plus, what are the points? Well, we use the bid points, not the offer points. The bid points are 130. Notice there's no negative sign in front of here, they're positive, which means we have a forward premium. So we add the 130 to get to 163.40. And we calculate the value in Australian dollars. Well, we have 163.40 currently. We entered in at 161. And of course, we have times 10 million pounds. This is the price in Australian dollars per pound. That's how many pounds we have. So this tells us how many Australian dollars we currently have. Now, we were long the currency initially. So what do we have here? Long the pound initially. So we have 0.024. This is the difference inside the brackets times 10 million. Is 240,000 Australian. That's 240,000. That's the payoff at this point in time. The 6-month forward contract expires here. The 3-month that we entered into will expire here. This one will expire at this will still be in force at 1.61. The one we enter into with the forward points will be 1.634. So this 240,000 Australian is the payoff here. We still got to get it back to here. So let's do that now. Third step, discount to the present being the 3-month point, because that's where we are now, using the 3-month LIBOR rate. So we have 240 Australian dollars. We look up the 3-month LIBOR rate for the Australian currency. We find 4.8, so it's 240 over 1 plus 0.048. Remember, it's the date. We multiply by the day count convention because that's quoted in an annual basis, but we only need 90 days. And since it's LIBOR, it's actual over 360, so we multiply the 0.048 by 90 over 360 to get the interest rate for this period here. Do the calculator work, we get 237,154 Australian. Now, we knew it would be an Australian because we had bought 10 million pounds here. We sold 10 million pounds here forward. Currencies are traded in pairs. The buying of the 10 million pounds, the selling of the 10 million pounds, that eliminates all British pounds. What's left is the only currency left are Australian dollars. So we knew that the payoff at the end, whether it be positive or negative, had to be in Australian dollars. Which goes back to what I said in level 1 when we trade currencies. Now, in trading this pair, we traded the Great British Pound to AUD, which if we write it in the ratio convention, it was AUD over Great British Pound. That's exactly what we traded. And I said in level 1, when we're trading currencies, it's important the order of the currency that we trade in. It's important which one is the base and which one is the price, because we will make our decisions based on the base. So in other words, if we want to go long the pound, we will buy whatever the rate is. If we want to go short the pound, we will sell whatever the rate is. However, our payoff is always in terms of the second currency. So if I trade US.CAD, my payoff will be in Canadian dollars. Now this is the tricky thing of currencies here. Follow me on this. I live in Canada. I want my earnings to be in Canadian dollars. But to have them in Canadian dollars, I must trade the US.CAD. So if we think about it in terms of base and price, and in terms of domestic and foreign, remember the base equals the domestic currency, because who lives in the basement? The domestic help, right? Then what I'm saying by living in Canada is I'm trading the domestic versus foreign. I'm suddenly making the Canadian dollar the foreign currency. But since my gains and losses accrue in Canadian dollars by trading this pair, I'm actually getting my gains and losses in the domestic currency. So when we use the domestic currency for the base and the foreign for the price, it's just a convenience. As I said before, it's just a convenience so that all of the math that we do and all of the formulas work out, as opposed to having to think about it all the time. It's just a convenience to make a mathematical point. It's not a rule in the market that the base currency is your domestic currency, because I'll trade the US CAD because I want to get my gains and losses in Canadian dollars, but the Canadian is not a foreign currency to me. It is my domestic currency. So for me, it's FD, not DF. But we don't really think about it that way because it's inconvenient to keep changing it for everybody's situation. We just say, look, let's just think about it this way, and then whatever happens with you happens with you. You figure it out in the end. So because we're trading the pound Aussie, whatever gains or losses we have would accrue in the Australian dollar, and that's exactly what they did. They accrued in the Australian dollar. All your gains and losses are in there. Now I think you can see why that is the case. Let's try another example. 6 months ago, a dealer sold 1 million Swiss francs against the pound, 180-day term, for an all-in rate of 1.4850. So this is the pair that was traded, the Swiss franc against the pound. We sold 1 million pounds against, 1 million Swiss francs against the pound, an all-in rate of 1.4850. The dealer now wants to roll that position forward another 6 months. So 6 months ago we did this. It expires today. Today the dealer wants to roll it forward another 6 months. Now, what we've done up here was exit a forward contract before termination. Here it has terminated, but we want to roll it forward. When we roll forward, we work with the bid and the offer slightly differently. So let me spend a moment to explain how the bid and the offer is going to work here, because we're rolling forward. Here's the current spot plus points. So it's 14939, 14941, and here's 1 month, 2 month, 3 month, 4, 5, and 6 month points on this pair. So because we're exiting one and entering another, the dealer will use an FX swap, a currency exchange swap, or a Forex swap. And that is a simultaneous spot and forward transaction. And that's what we're going to do. We're going to do a spot and forward transaction at the same time. We're going to buy 1 million Swiss because we sold 1 million Swiss. So to deal with this one, we got to buy 1 million Swiss spot, but we're going to sell 1 million Swiss forward. The end result is we're still selling 1 million forward. That could be a little tricky. Let me explain it here. 6 months ago, we sold 1 million Swiss against the pound. We want to roll that forward, so 6 months. We still want to maintain the position of selling 1 million Swiss 6 months out. But we have this pesky little contract to deal with, so we're going to do a spot transaction now to deal with this one and simultaneously go forward 6 months. So that means that in the end, we still want to sell 1 million Swiss against a pound. There it is right there. So we got to buy it first spot and then sell it forward. Because we're doing a simultaneous transaction, a common spot rate is applied to both legs. Because if we didn't apply a common spot rate, what would happen? Well, we're buying here, so we would have to buy on the offer, and then for the forward, we would have to sell on the bid. So just with the spread, we'd have to pay the full spread by doing this. We don't want to do that. So a common spot rate is applied to both. Well, what spot rate do you use? Typically, you use the mid-market. So this is 39 to 41. The mid-market is 40. So both legs will get the mid-market of the current spot, so 40. So when we're entering into a swap, we'll use a mid-market rate. When we're just exiting, if it's just a single transaction to exit, an offsetting transaction, we'll use a bid or an offer. But here we're doing a simultaneous spot and forward. We're doing two. We want the same rate applied to both legs, so we'll just use a mid-market rate for that contract. Okay, continuing on with this question. I'm taking this question, by the way, right from the reading. If you want to follow along in the blue box here, you're on example 3. Forward rates and the mark-to-market of forward positions. So the scenario I laid out is the scenario at the top of example 3 before we get to question 1. Question 1 does not pertain to the scenario. Well, it does and it doesn't. The scenario is we want to roll our position forward, but question 1 asks us something different right off the top, and you got to be prepared for that on the CFA exam. You'll be given a story, a scenario, and you might be given a question that asks you to solve something that isn't directly related to solving the problem itself, but still can be solved from the information in the problem. Number 1 says the current all-in bid rate for delivery of the pound against the Swiss in 3 months is closest to. So, okay, here's number 1. Let's just do that. Number 1, the current all-in rate for delivery of the pound against the Swiss franc in 3 months is, I put a question mark, is what? And this is where students get confused. It's like, hang on a second, delivery of the pound against the Swiss. So am I trying to figure out from the Swiss or from the pound point of view? That can get confusing. So I always say, the very first question you should ask is who lives in the basement, right? What are we doing with the base? So let's figure out what the base is. Who lives in the basement? It's the British pound. The British pound. What are we doing with the base? Are we buying or selling the base? Well, if we're delivering British pounds against the Swiss, the key word here is we're delivering pounds. So we must have pounds, and we're giving them in exchange for Swiss francs. We're giving the pounds. So if we're delivering, we must be selling. Think about it if you own a grocery store and you're making deliveries. You're making deliveries because you're in the business of selling stuff. You wouldn't deliver stuff you bought. You deliver stuff you sold, right? So we're delivering. So we are selling. Selling happens on the bid. Buying happens on the offer. So we're selling, so we know we're dealing with the bid, 14939. It's 3 months, so we look down for 3 months. We look down at the bid points, negative 25.4, so we'll put negative 25.4 in, 1.49136. The hard part is figuring out what we're dealing with. Because we have two currencies, right? You have a pound and you have a Swiss franc. And sometimes the wording of the question can make it seem, okay, hang on a second. What are we doing? Are we going long, a short, and which currency? So the easiest way to think about it is just get it all out of your head and say, what are we doing with the base? Let's start there. What are we doing with the base? Identify the base. Figure out if you're buying or selling. Once you figure out that you're selling and you know what the base is, the rest is easy. Number 2, this gets back to the problem at hand. The cash flow the dealer realizes on settlement. So 6 months ago, they entered into a forward contract for delivery, and now they want to roll it over. This is the current spot rate at the date that they want to roll it over. This was the original all-in rate. And the question specifically states at the very beginning, I'll just read it again so that we have it clear in our head. A dealer sold 1 million Swiss francs forward against the pound. So if we sold Swiss francs forward, that means we're going to receive British pounds. Well, the easiest way to figure out the payout is to say, well, how many British pounds would we have received? And how many British pounds would we receive if this were the rate? So let's have a look. On day 1, we sold Swiss, which means we're long the pound. We sold 1 million Swiss francs for delivery against the pound. Well, each pound costs us 1.485 Swiss francs. Each pound costs that. Remember, when you're looking at this, the base is always 1. So the base, the price currency is a Swiss. That's the price of a British pound in Swiss francs. So if we're selling 1 million of them, and each one, we need 1.485 to buy each pound, we're going to get 673,400.67 pounds out of this million francs at that rate. Well, at settlement, here's the spot rate now, 49.39, 49.41. But remember now, we're rolling our position forward. We just want to settle out this one and roll the position forward. We got to settle this contract because the counterparty to this first one is saying, where's my cash, man? So we got to buy. If we sold, we got to buy. So we're going to buy, which means we're selling pounds. Again, it's $1 million, but what's the current rate? Don't use 39, don't use 41. It's a mid-market bid on this one, right? We use 14940. So that is 669,344.04. So if we take 673 minus the 669, now notice I put a negative sign in front of this million because we have to buy. Here we sold the Swiss, we sold forward, we have the million, and we're going to deliver it at this rate to get this many pounds. Here we're buying Swiss, so that's a cash outflow, so that's negative. So it's negative 669. If you subtract the two, we get 4,056.63 in British pounds, an inflow in British pounds. This is the other tricky part that students get confused is how do you know it's British pounds? Well, it's very, very simple. Look what we did here. We're going to sell 1 million Swiss. We're going to buy 1 million Swiss. They cancel out. What are we left with? We're left with nothing but British pounds. So what flows through to the end must be British pounds. So it's easy just with a bit of logic. It can be confusing. I will admit to that. It can be confusing. All right, the third part of this question asks us, what is the all-in rate to sell Swiss francs against the British pound in 6 months if we used another dealer? Well, if we're using another dealer for another dealer, it's not a swap anymore. It's a whole new transaction. So if we're doing this with another dealer, we can forget about the midpoint of the market. Now we have to worry about bid and offer. So again, to solve this one, what's the very first question you should ask yourself when you get into any situation like this? What are we doing with the base? The base is the British pound. Let's read this again. What are we doing with the base? All-in rate to sell Swiss against the pound. Well, if we're selling one, we must be buying the other. You can't sell both. If we were buying Swiss, we'd be selling pounds. If we're selling Swiss, we must be buying pounds. It's just the exact opposite. So what are we doing with the base? We're buying. Buying happens on the offer. 14941, 14941. So we go down 6 months. We have negative 54, so we'll subtract 54. Notice it's 0.0, so I didn't bother with the 0.0. There's no point. There's no point. Anyways, we get 1.4886. And there we go. So it's, again, let me point out, the currency work can be tricky because there are two, and you're always thinking, well, hang on now, if it's this currency, it's a bid. If it's that currency, it's the offer. Are we long? Are we short? What the hell is going on? Just clear your head. Ask yourself, what are we doing with the base? Identify the base. What are we doing? There's only two things you could be doing, buying or selling. How do you figure it out? Either the question will tell you you're buying or selling, or it'll tell you what you're doing with the other currency. Whatever you're doing with the other currency, it's the opposite with the one you need. If you're selling the other, you must be buying the one you're interested in. Once you know if you're buying or selling, you know if it's the bid or the offer, off you go. All right, there's another question in the same example 3. And I'll read it, and I've given you the main points here, but I'll read it just so that you have the narrative as well. Some time ago, Laurier Bay Capital, an investment fund based in Los Angeles, hedged a long exposure to the New Zealand dollar by selling New Zealand dollars, 10 million New Zealand dollars forward against the US. The all-in forward price was 0.7900, and the pair was USD over NZD. So, the key point, sold 10 million New Zealand against the US, all-in forward price of 0.7900, and here's the pair. What's the base? We can see the base is the New Zealand dollar, the price currency is the US dollar. 3 months prior to settlement, Laurier Bay wants to mark this forward position to market. The bid offer for the currency rate, for the spot rate, the 3-month forward points, and the 3-month LIBORs are as follows. The current spot is there's the bid, the offer. 3-month points, negative 12.1 to negative 10. And 3-month LIBOR on the New Zealand dollar, 3.31. 3-month LIBOR on the US dollar, 0.31. And at number 4 here, we're only going to do, actually we'll do 4 and 5. Number 4, The mark to market for Laurier Bay's forward position is closest to. So let's mark this to market. 3 months to expiration. We want to mark to market the position. How do we do that? Well, what we have to do is we have to imagine entering into an offsetting position. And since we have 3 months to go, we have to enter into an offsetting 3-month forward position, figure out what the payoff is 3 months from now, and then bring that back to today. So step number 1, let's just enter into an offsetting position. Well, if we sold 10 million New Zealand against the US, what must we do to clear it up? If we sold 10 million, we must buy 10 million New Zealand dollars. And in the process of buying 10 million New Zealand dollars, if we sold 10 million New Zealand dollars, if we buy 10 million New Zealand dollars, the New Zealand dollars cancel out. Whatever's left over should be in US dollars. So our answer will be in US dollars, right? So we'll buy 10 million New Zealand dollars against the US, but we have to buy it 3 months forward. What are we doing with the base? The base is the New Zealand dollar, right? What are we doing with the base? If we're buying 10 million New Zealand dollars, we must be buying the base. Buying happens on the offer. So our 3-month forward rate will be the 0.7830 plus the forward points on the offer, and that's a negative 10. So we'll take off 10, we get 0.7820. 0.7820. At what price did we enter the contract? 0.7900. At what price are we exiting? 0.7820. Here's the spread on the exchange rate times, how many dollars was it? 10 million? 80,000. That 80,000 must be in what currency? Must be in US dollars. So, in other words, we were short at 79. We covered at 78.20. So we had an 80 pip spread on the profit multiplied by $10 million. $10 million of 80 pips gives us 80,000 US dollars. But that's in 3 months' time. Remember, that's over here. We want to settle here. There's 3 months to go. It says right here, 3 months to expiration. There's 80K over here. We got to bring this back over here. So what we need is we need the LIBOR rate for the US dollar because we're discounting US dollars. And it is 0.31. So it's 80,000 divided by 1 plus 0.0031 because it's 0.31. And then, of course, actual over 360. What's the actual number of days? 90 days because it's a LIBOR rate. So we use the actual over 360. We get the 79,93805. So to mark this to market, we would receive this. The LA-based firm would receive 79,938.05 US dollars today. Well, that's just mark to market. It would give them a value of that. Perhaps they're closing out a quarter and they want a mark to market value for the forward contract. Doesn't mean they actually get it, not until they actually do close the contract. But if they want a mark to market for valuation purposes, there we go. Okay, so for what we just did, reverse the position. So in other words, instead of selling 10 million New Zealand against the US, let's say we sold 10 million US against the New Zealand. How would we solve this problem? We're reversing it. By reversing it, what we're really doing is we're just inverting it. So it's just 1 divided by. So we're selling New Zealand dollars. Since we're selling New Zealand dollars, we have to come up with our 3-month forward rate, right? What are we doing with the base? If we sold 10 million against the US originally, that means we sold 10 million. That means we must be buying the New Zealand dollar. If we're figuring out our mark to market, we go into an offsetting transaction, which means we're buying 10 million to close this 10 million. If we're buying, we must be selling the New Zealand dollar, right? And it's easy to see that if we sold 10 million US and now we're going to buy 10 million US to create our hypothetical offsetting position, the US will cancel out. Whatever's left over must be in New Zealand dollars, right? So since we're selling New Zealand dollars, the relevant entry for us is the bid, 0.7825. So 0.7825, but we need the 3-month forward. So what are the 3-month points? Negative 12.1. So I just put it in decimal form here. This is 12.1 in decimal form. We get 0.78129. Since we're reversing the position, instead of taking what we did up here, notice we did 0.79 minus 0.782. Here it's 1 over 0.79, because we're reversing it, minus 1 over 0.78129 times the 10 million. That'll give us a negative value, negative 141,117. Does that make sense? Well, if the U.S. was a positive payoff, the New Zealand must be a negative payoff in New Zealand dollars. So it's negative 141,117, but that's in 3 months' time, so we have to discount it. We have a different discount rate, different LIBOR rate for New Zealand, 3.31, so it's 114,117. Actually, I made a small mistake here. Let me correct it. Negative 114. This answer here is negative 139. There, it's all corrected. In fact, I could do a little bit better over here. Negative equals. There we go. So negative 114,117 over 1 plus, and there's the LIBOR rate, 0.0331, and the actual over 360, it's 90 days. We'll get negative 139,959. This one's a little tricky because you have to think, well, okay, so what am I doing? The easiest way to look at it is if it's the other position we're taking. This is our side. This is how we calculate the other side's position. The other side would just say, well, I'm just inverting whatever the rates are, 1 over. And that'll give me the opposite of whatever we're calculating for US. And they'll be in opposing dollars. This is in US dollars. This is New Zealand dollars. Why are these two, 79,938 and 139,959? Why can I not just take the 79,938 and divide it by whatever the spot rate is to get what the New Zealand dollar is? Why can't I do that? Well, because you have different discount rates. You have different discount rates that you're discounting to the present, so it's not going to work out that way. All right, we're going to do a whole bunch of learning objectives at the same time here. LOS, E, F, and G. Explain, evaluate, describe. Let me read them for you, and then I'll say a note on it before we go ahead. LOSE, explain international parity relations, covered and uncovered interest rate parity, purchasing power parity, and the international Fisher effect. So there's actually 4 steps we go through. The covered, then we'll look at the uncovered. We already saw the covered. Then we'll look at the uncovered. Then from there we'll go to purchasing power parity. Then we'll combine uncovered and purchasing power parity, and that'll give us Fisher. So there's 4 steps we go through here. F is describe relations among the international parity conditions, which we do as we go along. And G is evaluate the use of the current spot rate, the forward rate, purchasing power parity, and uncovered interest parity to forecast future spot exchange rates. I'll answer G right now. Doesn't work. Doesn't work. So there we go. G is out of the way. It just doesn't work. Evaluate the use of using these things. That's not worth it. There's nothing there. It is a random walk in the short to midterm. A random walk. So why are we doing this? Why are we even bothering doing this? Well, listen, if everything worked out, there'd be no way to make money in the currency markets. So understanding the theory of how everything works out tells us where it breaks down, tells us where we can make money. If we have a theory that holds, then there's no money to be made. So we should learn the theory, which doesn't hold. That's a big question, is why are we learning something that doesn't hold? So you know exactly where it breaks down, so you know exactly where you can make the money. There you go. Or lose the money. I keep saying make money as if you know how it's done, you'll just make money. You can lose. You can lose. It just shows you where the opportunity to profit is. All right, let's go ahead here. So parity relations, what is all this? It is a framework for developing a view about future exchange rate movements. About future exchange rate movements, whether a currency is more likely to appreciate or depreciate over a longer term time period. That's the best you're going to get out of currencies, by the way, my friends. If you want to know what's going to happen to the currency this week, I haven't got a clue. I may have a leaning. I may say, I think this and I think that, but I'm never more than 50-50 on that. That's just currencies. Currencies are... you can flip a coin a lot of times. Sometimes, if you're willing to take a position and stick with it over a period of 3, 4, 5, 6, 7 months, then yes, we know what we're doing. You can feel a lot more assured there. But we must make a distinction between the spot market and the futures market. If you're trading currencies in the spot market, there's not a lot you can do other than bet. Up or down, up or down. That's it. Because you're certainly not going to hold a spot position for a year. You could get murdered holding a spot position for a year. All right, so a framework for developing a view about future exchange rate movements. So parity conditions. What are parity conditions? They describe the interrelationships that jointly determine long-run movements in exchange rates. I'm not going to write out the word exchange rate from now on. I'm just going to put FX. Everyone understands that's foreign exchange rates, interest rates, and inflation. So there are three things, and we're looking at the joint interaction between the exchange rate, the interest rate, and inflation. Parity conditions describe interrelationships that determine the long-run movements in these three. Long run, key word. And the parity conditions are the basic building blocks for describing long-term equilibrium levels. Again, long-term equilibrium levels for Forex rates. So what's the long term in Forex? 5 years, 3, 5, 7 years. That's a long time to hold a spot position, because in the short term, a currency can deviate dramatically from its long-term expected or its long-term equilibrium as described by international parity conditions. And over that long period of time, the three things that we look at, the interest rates, inflation, and the foreign exchange, can change dramatically, such that its long-term equilibrium doesn't necessarily have to be the one that you selected 5 years ago. It's a tough game with currencies. Yet there are people who think that they can be professional currency traders. I don't think that you can be a professional currency trader and just deal with currencies. You have to look at currencies as an addition to what you're already doing, and as long as you're willing to hold a position for a period of time, then I think you can do okay. But if you're just a spot trader, what the market calls spot monkeys, if you're just a spot monkey and you're just trading in and out of the spot, go to a casino. At least there you can drink and see pretty girls, right? All right, so here's the real exchange rate. Notice we're using real exchange rate. We'll get to tearing apart the nominal rates a little later into the real exchange rate. And here is time. And this middle line up here is called a long-run equilibrium path. I don't like the idea of calling it a long-run equilibrium path. I don't like that, and here's why. If, in fact, we think of currencies in the short to medium term as a random walk, then the theories and the models of economics, I don't think are appropriate to describe a long-run equilibrium path for a currency. I think a more appropriate field of study would be complexity theory. And complexity theory doesn't talk about equilibriums, it talks about attractor points, that there is an attractor point where if something is drawn too far away from it, it eventually comes back to that attractor point. If it's drawn too far above, it eventually comes back to that attractor point, but it's an attractor point as opposed to an equilibrium. And if we use the ideas of complexity theory and chaos theory, I think that currencies start to make a little bit more sense. This is a fundamentally driven long-run equilibrium path. Fundamentally driven by what we're going to talk about, these parity conditions. And this is the short, we'll call this a midterm path. A short-term path would start to look far more erratic like this. Currencies can do all sorts of funny things like that. That would look like a typical short-term currency movement. We'll call this smoothing out the midterm path. And this is the actual trend in the real exchange rate. Notice currencies tend to do this more often than a normal probability distribution would say that they should. Temporary overshoots, temporary undershoots. These are nice to find. I think right now, if we're looking for overvalued or undervalued currencies, if this being an undervalued, something that is a temporary undershoot, I think right now is the Mexican peso. Primarily because of build the wall, and let's make Mexico pay for it, and let's kick them out of NAFTA, or at least make the deal worse for them. I don't know that he's going to be able to get that done with Canada and Mexico on both sides without significantly raising the cost of production to American consumers. And his party will gently tap him on the shoulder and say, look, you're going to lose the next election if you raise prices in the economy to consumers. That's just the reality. But Trump, I don't know if he thinks that way. He's not a politician, so I think he thinks, who cares if I lose the next election? It's the thing I want to do. Who knows? But I'd be looking at the Mexican peso in this respect. So this is a sort of a nice way to think about it, that if you look at parity conditions and what we're going to talk about as being long-run attractor points on a currency, okay. On the real exchange rate, okay. But if you're going to use this kind of stuff, parity conditions, to start trading the forex market over the next week, no, you're gonna get killed. You're better off just to flip a coin than rely on purchasing power parity to say, this one is overvalued, this one's undervalued. That's what I'm going to do. So before we jump into the four relationships that we'll look at, the first one right here being the covered interest rate parity, which we've already seen. Let's just sort of try to get a big picture on what we mean by parity relations and why we'd even look at anything like that. Parity conditions show how, let's just skip all of this, they show how all of these things would be linked in an ideal world. How all of them would be linked. So what are the things we're going to look at? Expected inflation differentials. We'll see this in purchasing power parity. Interest rate differentials. We see this in the covered interest rate parity and the uncovered interest rate parity. Forward currency exchange rates. We're going to talk about those in terms of the covered interest rate parity and uncovered interest rate. Current spot exchange rates and expected future spot expect rates. So if parity relations hold, if all of the things we look at, if they hold, then all of these things will be interconnected. There'll be a relationship among these that allow us to determine with accuracy what each one should be. Sounds interesting, right? Well, let's look at some empirical studies here, or the results of empirical studies. International parity conditions rarely hold in either the short or the medium term. So if you're looking on a week-to-week or month-to-month basis at parity, international parity conditions, and trying to determine the direction of spot exchange rates, well, doesn't really work out that way. Now, when I say that they don't accept covered interest rate parity, that must hold simply because there is an arbitrage relationship that will force it to hold. Further, forward exchange rates have been found to be poor predictors of future spot exchange rates. So you'll recall in covered interest rate parity, we looked at two scenarios. We can invest our money at the domestic rate, or we can convert our money at a spot rate to a foreign currency, invest in the foreign market, and then enter into a forward contract to bring it back. We can derive the price of that forward contract by the interest rate differential between the two countries. Well, that forward rate is an arbitrage conclusion. That's what this statement down here is talking about. It's talking about that forward rate. It's saying that the forward rate has been found to be a poor predictor of future spot rates. So let's look at our four relationships, and they progress from covered to uncovered. We talk about interest rate differentials. Then we'll move to purchasing power parity, where we talk about inflation differentials. Then we'll combine interest rate and inflation differentials into the Fisher effect, or the international Fisher effect. So covered interest rate parity, we've already seen this, describes a riskless arbitrage relationship. It is supported broadly, but specifically supported where capital is permitted to flow freely. Spot and forward forex markets are liquid. Financial market conditions are basically stress-free. And the reason covered interest rate parity holds is because of this word right here, covered. I'll get a better pen here. Covered. It has to hold because if it didn't, there is a riskless profit arbitrage opportunity. And it will be arbed away until it does hold. All right, now that we get covered interest rate parity, we can recall what that was. Let's look at uncovered interest rate parity. And in a nutshell, this is what it's saying. The conclusion that you get to with the forward rate under covered interest rate parity would hold under uncovered interest rate parity, even without arbitrage. Even if you shot all the arbitrageurs and there was no such thing as arbitrage, it would still hold. It would not require arbitrage to be so. That's the conclusion of uncovered interest rate parity, just in a nutshell here. The expected return on an uncovered, that is an unhedged, an uncovered foreign currency investment should equal the return on a comparable domestic currency investment. So if we look at our domestic interest rate, let's say that it's 5%. 1 plus, that's $1. 1 plus the domestic interest rate returns 1.05 or a 5% return. If the foreign interest rate is such that it returns 10%, the uncovered interest rate parity, UIRP, I'm not going to write it out every time, I'm just going to put UIRP. UIRP implies that 1 plus the foreign exchange rate, that's 1.1, multiplied by 1 minus the change in the spot rate, minus 1, should equal the domestic interest rate. So if we're getting 10% return, if this is 110, what would we multiply it by and subtract 1 to get the interest rate? Basically, we can think about it in terms of it must be about a 5% reduction in the spot rate. So if we're getting 10% here with a 5% reduction in the spot rate, should leave us with 5%, roughly speaking, right? So this term here, all of this simplifies to the interest rate in the foreign market minus the percentage change. This is expected now, the E, when we put a notation of E at the top, it's expected. In the chapter, sometimes they use E and sometimes they use epsilon. It doesn't really matter which one you use. Both of them mean expected. So we're taking whatever interest rate we have in the foreign market, 10%, and we're subtracting it from it, the expected change in the spot rate between the two currencies, and that should equal the domestic interest rate. So it really comes down to an interest rate differential. And if you do some rearranging, there it is right there. The interest rate differential between the two markets is equal to the expected change in the spot rate. So the expected change in the spot rate, expected percentage change in the spot exchange rate should equal the interest rate differential. Let's say that it does hold, and this is what we're going to say here. Even when it does hold, the standard deviations of returns on the interest rate, the domestic interest rate, are 0. It's a money market investment. It will be 0. The standard deviation of returns on the foreign interest rate minus the spot rate is not equal to 0. What we're saying here is, in terms of return, even if uncovered interest rate parity held, even if this relationship held in the absence of arbitrage, there's no arbitrage, the market would just make it so because informed investors would trade it to that point. Let's say that even if it did hold and you had the same return, you don't have the same risk. Remember, these are risk-free rates now. ID and IF are risk-free rates. So that's a risk-free rate in the domestic market. This looks like a completely risk-free investment. This is a risk-free rate in the foreign market. That's a completely risk-free investment. But the addition of the exchange rate, right here, the addition of the exchange rate adds variability. Suddenly, the second one, the standard deviation of returns on the second one are not identical. So even if they did hold, they still would not be identical investments, because one would be risk-free, the other would have risk, which means the expected change in the spot rate could not completely eliminate the interest rate differential. There'd have to be some advantage left to investing in the foreign risk-free rate versus the domestic. But there we have a problem, because within the foreign market itself, the individuals in the foreign market, that is their domestic risk-free rate. So is it proper that their domestic risk-free interest rate should reflect variability in the spot exchange rate? So we have a bit of a problem that even if it did hold, there'd be risk differentials between the two, so they would not be identical. So if the market priced it so that they would be identical, the foreign interest rate would have to hold some standard deviation, some risk factor because of that, but it's a risk-free rate, so it can't. Interesting, isn't it? So let's just continue on with what is implied under the uncovered interest rate parity. Under UIRP, the country with the higher interest rate is expected to see the value of its currency depreciate. If UIRP held, there would be no excess return that could be gained by going long a high-yielding currency and short a low-yielding one, because the high-yielding currency would be expected to depreciate. There'd be no incentive to shift capital from one currency to another. Empirical studies fails to hold over short and medium terms. In other words, UIRP fails to hold. It simply doesn't. Interest rate differentials are generally a poor predictor of future exchange rate changes. High-yield currencies tend to strengthen, not weaken. Forward exchange rates are a poor predictor of future spot exchange rates. And finally, current spot exchange rates are also a poor predictor of future spot rates. So there's a lot of problems with the uncovered interest rate parity. Covered has to hold because there's an arbitrage relationship that makes it so. Uncovered is saying, yeah, but even if you didn't have arbitrages, the market would make it so. Apparently not. And in fact, most of the inputs to the uncovered interest rate parity, as we see here, are just absolutely poor predictors of everything else. All right, let's go to some problems here, do some examples with what we've got so far with the covered and the uncovered. And this is example 4 in your books for this particular reading. Example 4: covered and uncovered interest parity, predictors of future spot rates. And I'll read it. I've replicated the important information here, but I'll read it for you. An Australian-based fixed income asset manager, so they're Australian-based, so the Aussie is going to be their domestic currency. The Australian-based fixed income asset manager deciding whether to allocate money between Australia and Japan. Note that the base currency in the exchange rate quote is the domestic currency for the asset manager. Well, we've already said that. So here's the exchange rate quote, the yen over the Aussie, and the Aussie is the base, the basement. Who lives in the basement? I'm going to keep saying that over and over and again, right? The domestic help lives in the basement. So the spot mid-market quote is 79.25. I'll get to this little box later on. Is 79.25. This is just the information given in the problem. 1 year forward points, negative 301.9. So we're going to have a forward discount. 1 year Aussie deposit rate is 5%. 1 year yen deposit rate is 1%. We can see the domestic interest rate is higher than the foreign interest rate, which means we're going to have a discount. If it were the other way around, it would be a premium. So the first question says, based on uncovered interest rate parity, over the next year, the expected change in the spot rate is closest to, and that's why I said based on UIRP over the next year, the E at the top there, this is the spot rate, SFD. E means the expected spot rate will be closest to. Let's see what we have. Here I've just written out the interest rate differential. I know it's IF minus ID, but I'm just doing it in the positive note here, ID minus IF. It doesn't matter which way you do it. I just want to find the absolute value of the differential. We got a 4% differential. The domestic currency has a 4% advantage over the foreign currency on the interest rate differential. So the domestic gets 5%, the foreign gets 1%. So a foreign investment would also have to buy 4% more domestic currency to equal the 5%. So if we invest in foreign currency and it gets 1%, when we translate back, the foreign currency should be able to buy another 4% of the domestic currency. Well, what would happen? What needs to happen for that to be the case? If the Australian dollar gets 5%, or the Australian investment gets 5%, the Japanese investment gets 1%, by the time it's done, we need to rebuy Australian dollars so that we have more of them. We need to buy 4% more. So the Japanese yen would have to strengthen, or the Australian dollar would have to weaken by 4%. And that's what uncovered interest rate parity is trying to tell us, is that the higher yielding currency would tend to depreciate. Empirically, that's just not the case, and having traded currencies for quite a while, some time ago, that is definitely not the case. Low-yielding currencies tend to depreciate more. High-yielding currencies tend to appreciate more. So that's just a wrong statement. But that's the conclusion of UIRP. If it held, that's what we would see. We rarely ever see this happen, so we know it doesn't hold. And the next question here. The best explanation of why this prediction may not be very accurate, the prediction that the Australian dollar will drop by 4%, may not be accurate prediction because there is no ARB condition that forces UIRP to hold. There is no ARB condition forcing it to hold. If there was, then it will. But there is no ARB condition forcing it, so there's no reason why. There's any stepping in to fix this is a risk trade, not a riskless trade, so it's not going to be done. It'll be assessed and rejected based on just history of, well, you know what, it's high-yielding currency. It's not just going to drop. Number 3, using the forward points to forecast the future spot rate 1 year ahead assumes that. So using forward points to predict the future spot rate 1 year ahead assumes that UIRP holds. If we're trying to predict the future spot rate from the forward points, and remember the forward points are points that we get from a covered interest rate parity, so that will have to hold in a covered sense. That would be the forward points. But we've already said that the forward rate is a poor predictor of the future expected spot rate. And even if we assume that UIRP holds, even if we assume that it holds and that it will equate, we must also assume risk neutrality, because we can invest at 5% risk-free. We can invest at 1% in the Japanese market at that risk-free rate, but from an Australian perspective, there's more risk in this trade because we're open to the fluctuations of the spot. So for an investor to be indifferent between them, we would have to assume that an investor is absolutely neutral towards risk and always just chooses on return. So we have to make two big assumptions that are simply not true. Investors typically are not risk neutral. They're typically risk averse, and UIRP, as we've said, does not hold. If we forecast that the spot rate 1 year from now will be 79.25, the current spot rate right now is 79.25. If we forecast that the future spot rate is going to be 79.25, the exact same thing. That assumes that spot rates follow a random walk. We covered this in our reading on time series, that if something follows a random walk, the best estimate of the next period's value is this period's value, because everything is just an error term. So if we just follow the random walk, if we assume it's a random walk and say, well, a year from now it's going to be exactly what it is right now, and everything else is just error, that's the best that we can do. That means you're implying that spot rates follow a random walk. Here we're not doing that. We're adding points, and we're saying, well, that the spot rate in the future is going to be lower than the spot rate is today, because we have a 1 year 4-point discount, and so we're not saying that there's a random walk. We're saying that there is something involved, except the something that we're saying just doesn't seem to hold much believability, either in logic or in empirical evidence. All right, let's move on to the third one. We've done two with interest rate differentials, the covered and the uncovered. Now we're going to look at purchasing power parity, which looks at inflation differentials. It is a relationship between exchange rates, foreign exchange rates, and inflation differentials. We typically shorten purchasing power parity to PPP. And this is based on the law of one price. It seems to show up everywhere, this law of one price, right? Identical goods should trade at the same price across countries when valued in terms of a common currency. So if I can buy a particular product in Canada that is the exact same product in the US, once I convert the US price to a Canadian price, both those Canadian prices should be identical because they're the same goods. The foreign price of a good, let's denote as capital P sub F with the power X. It's just the price of X. It's the foreign price of a good X. The domestic price of a good X is P X sub D. So as long as we know that P with the power term, it's not really a power term, it's just a notation. PX is the price of a good X, foreign market, domestic market. So let's just make that now. What we're saying here is that the price of the good in the foreign market should equal the price of the good in the domestic market exchanged at the current spot rate. whatever the spot rate is, if we, both sides now should express the price of the good in terms of the foreign currency. So if, this is not an example, this is just sort of what this thing is saying. It's saying if the price of a particular good in euros is 100 euros, and the spot rate between the US and the euro is 1.4, that means a euro buys 1.4 US dollars, then the price in US dollars should be 140. I can take my $100, euros, and buy that particular good, or I can take that 100, exchange it for US dollars, get 140, and that good should also be purchasable for 140. If it's not, it sets up something called goods arbitrage. So this is an example where suddenly something is much cheaper in the US than it is in Canada. It's in my interest to drive over to the US, buy those items in the US, drive back to Canada, and sell them at the rate that it sells for here. That's called goods arbitrage. Not as easy to do as financial arbitrage, because there's actually costs in handling anything that's physical and that's real. So purchasing power parity doesn't absolutely have to hold. It doesn't have to be 100 euro and 140 for it to still hold. It doesn't have to be penny for penny because of those costs, right? We'll introduce some of those a little later on. So there's an absolute version of PPP. There's there's a couple of versions. Let's start with the absolute version. The absolute version of PPP extends to the general price level. It doesn't just say, well, this shoe versus that shoe, this movie ticket versus that movie ticket. It doesn't do that. It just extends to the general price level altogether. So the price level in the foreign country should equal the price level in the domestic country converted at the spot. Whatever the spot rate is, the two should be equal. Or what we can say is that the spot rate of the foreign to the domestic is the ratio of the two price levels, the foreign level and the domestic level. Here's a big assumption, though, and this is almost why you can look at the absolute version of PPP and almost reject it out of hand. It assumes that all domestic and foreign goods are tradable, and that price indices in both the domestic and the foreign country are identical. In other words, they have the same goods and services and the same weights. Typically across countries, even something like Canada and the US, even though we're right beside each other, if we look at the composition of our price index and the basket of goods that makes up the price index and the weightings applied to each, you'll find that they're different. They are different, so that we cannot compare them on that sense. They are not identical. Now, all the goods, most goods are tradable, but we have a border. So suddenly we have some thickness in the trade. There is some impediments to that trade. A lot of goods just don't walk across a border. They just don't flow freely across a border. Equilibrium exchange rates between two countries is determined by the ratio of their nominal price levels. That's what this thing is saying, that the equilibrium exchange rate between two countries is determined by the ratio of their nominal price levels if all goods are tradable and the two price indices are identical. So any difference between the two, if we believe in the absolute version of purchasing power, if we're seeing that it's not equal, then we say, oh, well, then chances are not all goods are tradable, or their price indices are not identical. We would say it is one of those two reasons that results in the difference. So continuing on with the absolute version, purchasing power parity, highly unlikely to hold. It assumes goods arbitrage will equate prices, and like we said, highly unlikely to hold. Big reasons: transaction costs, trade impediments. So goods arbitrage will not equate prices. That's the conclusion we got to by accepting the absolute version. That if they don't equate, if the prices don't equate, it's got to be something that stops goods arbitrage from happening. There's a relative version of PPP, and it assumes these costs are constant. Any of these costs that are stopping goods arbitrage, any of them, it just assumes, okay, so there are those costs, but they're constant over time. They're not changing over time. The costs are constant over time. Then what it's saying is that the percentage change in the spot rate should be somewhat equal to the inflation differential. With pi here is a notation for inflation rate. So it's the inflation differential. The change in exchange rates is roughly equal to the inflation differential. So that the inflation differential, the widening or the tightening of the differential, should have a direct effect on changes in the exchange rate. Basically, the currency of the high inflation country should depreciate relative to the currency of the low inflation country. And we're going to reintroduce this inflation differential a little later on. It doesn't talk about much in empirical observations about this, but let me tell you my experience with this particular thing. Most central banks target a range of inflation anywhere from 1 to 3%. Typically, as inflation drops closer to the lower part of the bound, the 1% bound, it tends to weaken the currency. It tends to weaken the currency, and you would think, but shouldn't it strengthen the currency? Well, no, it tends to weaken the currency because it reduces the prospects for an interest rate increase. Suddenly we're moving from the inflation differential back to the interest rate differential. So we're seeing that maybe the inflation differential gives us some information about what the interest rate differential is, and it's the interest rate differential or the expectation for the differential that drives the change in the spot rate, not the inflation differential itself. In other words, this is not a direct relationship, but if you think of a path diagram, this expectation would lead to an expectation of the interest rate differential, which would then lead to an expectation of the change in the spot rate. So it's not one regression with two variables, the inflation differential and the interest rate differential. It's two consecutive regressions, the inflation differential on the interest rate differential and the interest rate differential on the change in the FX rate. So as it moves closer to that 1%, it tends to weaken because it removes that prospect for interest rate increases. As inflation starts to creep up towards the upper part of the band, now all of this is premised on central bank credibility. If the central bank is not credible, then none of this will matter. But as it inches closer to the 3% level, the upper part of the band, there is an increased expectation that there'll be an interest rate increase, thereby widening the interest rate differential. So the currency of the high inflation country says should depreciate, but it actually appreciates because an interest rate hike is expected relative to the currency of the low inflation country. However, if inflation gets much above the upper band and starts hitting 6, 7, 8, 9%, that's when it starts to have a detrimental effect on its own on the currency. That's when it escapes the clutches of the interest rate differential and starts to stand up on its own and have some explanatory power on its own. Only once it gets far outside that range. But anywhere within this particular range, it really is just telling the market what its expectations of an interest rate differential would be. Not that this has a direct effect, but an indirect effect. Let's look at the ex-ante version of PPP. We have the absolute version. That's the price level for both countries. We got the relative version saying, okay, great, there are costs, but they're going to stay constant over time. So let's just look at the change in costs in the two countries, the inflation differential. The ex-ante version of PPP says, don't look at the inflation differential, look at the expected inflation differential, ex-ante. So the relative to ex-ante just goes from observed inflation to expected inflation. Expected changes in the spot currency rates are driven by expected differences in inflation rates. And again, I'm going to just restate this in a way that's a little bit more real world. Because this theoretically sounds good, but we're missing the variable, the interest rate differential. So somebody in the markets, a practitioner would read it this way: expected changes in the spot foreign exchange rates are driven by expected differences in interest rates driven by expected differences in inflation rates. So the mechanism that changes the exchange rate is the interest rate differential. The mechanism that changes the expectation on the interest rate differential is the expectation on the inflation differential. So this is saying that the percentage change the expected change in the spot rate, the percentage expected change in the spot rate, is equal to or a function of the expected inflation differentials between the two countries. Countries that are expected to run persistently high inflation rates should expect to see their currencies depreciate over time. Now, for something like this, I would say, okay, that makes sense because there's two things wrapped up in this statement, and it's all tied into persistently high inflation rates. High inflation rates on their own do not cause, I don't think, cause this effect. But high inflation rates relative to the acceptable band will. What really drives it is this word persistently, right here, persistently. Because if a country allows persistently high inflation, that means they've allowed it for a long time, the central bank has no credibility. Even if they say that they're there to promote price stability, if there has been persistently high inflation for a period of time, the central bank loses credibility. Suddenly the interest rate differential doesn't matter because the central bank has no credibility anyways. Then the inflation differential really drives it. And this is probably a real result or an empirically validated result. Should expect to see their currencies drop over time. All right, so let's continue on with our purchasing power parity here. Inflation differentials across countries cause nominal exchange rates to adjust. At least that's what it's saying. Both the relative and the ex ante is saying that inflation differentials, whether observed or expected across countries, will cause the nominal currency rates or exchange rates to adjust in order to re-equilibrate real purchasing power. Real purchasing power. Well, that brings us to the concept of real foreign exchange rates, real currency rates. Captures real purchasing power of a currency defined in terms of the amount of real goods and services it can purchase internationally. So let's introduce that and see if that changes anything for us here. So Q we'll call the real exchange rate. So instead of just S, we've now called it Q. Q is the real exchange rate, which is equal to the spot rate times the domestic price level in the foreign currency, divided by the price level in the foreign currency. So if something is $100 in the, let's say the price level, and the price level always starts at 100, then it's 101, 103, 109, 110. It gives you some idea of where it's going. Let's put it at 120. So the price level in the domestic currency is 120, multiplied by the exchange rate and divided by the foreign price level. That will give us the real exchange rate, adjusted for the price level. So if we both have, if there's inflation in both countries, but one is higher or one is lower, it'll at least give us a real exchange rate between the two. And then all we're doing here is we're just taking it and rearranging the terms, bringing the spot rate outside, bringing the ratio of the two price levels in here. Well, the price level is determined by the CPI in each country. So real exchange rates can be seen as a function of the spot rate between the two currencies multiplied by the ratio of their CPIs. Empirical studies, what does it tell us about PPP? Whether we look at nominal exchange rates, real exchange rates, whatever we're looking at, what does it tell us? Real exchange rates mean revert in the long run. In the long run, well, that's 3 to 5 to 7 years. Real exchange rates mean revert. So that, what is that really saying? That is saying that nominal exchange rates gradually gravitate towards their purchasing power parity-based values. In other words, long-run PPP equilibrium values. So in the long run, we find that in the short run and in the intermediate term, PPP doesn't help us very much, but in the long run, currencies tend to revert or gravitate towards their PPP-based values. But the PPP-based value is not constant. The long-run equilibrium value of the real exchange rate is not constant. We're going to see that a little later on when we assess long-run equilibrium, because this is what this is saying, is that real exchange rates will revert to that in the long run. Well, okay, if it reverts to that in the long run, let's assess what that is. And we find that that's not constant. So how do we work with that, right? And we're going to see a couple of models where we start with the equilibrium rate and we say, well, okay, perhaps we can talk about short and medium term fluctuations around the rate as opposed to try to predict what it is. Maybe we can predict a direction instead of a level for the currency, and we'll get to that one. So to recap, because this can get confusing, we've done covered interest rate parity, which looks at interest rate differentials, but because of the existence of arbitrage, it must hold. However, we find that the forward rate we achieve out of covered interest rate parity is a poor predictor of what the future spot exchange rate will be at that point. We move to uncovered interest rate parity, where we said the interest rate differential, regardless of arbitrage, if there's no arbitrage, that interest rate differential will drive the exchange rate. And we found that nope, no, in fact it doesn't. In fact, it does the absolute opposite of what it says. Then we moved on to purchasing power parity and said, okay, well, if interest rate differentials can't help, maybe inflation differentials can help. And so we looked at inflation differentials, and the end result is that, hey, you know what? Maybe there's something here, but it's in the long run. It's in the long run. So now we're going to move on to the international Fisher effect, where we say, hang on a second now. Why don't we, if we talked about the real exchange rate, and we've talked about the nominal exchange rate, and we've talked about inflation, there's a relationship there, right? The nominal exchange rate is the real exchange rate multiplied by inflation. So why don't we bring it all together now? Why don't we bring an inflation differential and a real exchange rate differential together? So instead of looking at a nominal interest rate differential, let's break it apart and look at the two components. Let's move on to that. So number 4, looks like a lot of notation on the screen, right? But it really isn't. These are just sentences. They're just sentences with different words, that's all. So number 4, the Fisher effect and real interest rate parity. Notice what we're looking at here now. We're looking at real interest rate parity. The first two interest rate parities we looked at, covered and uncovered, dealt with nominal interest rate parity. Now we're dealing with real interest rate parity. So if we're dealing with real interest rates, we know we're going to have to deal with inflation somewhere, right? Combines both interest rate differentials and inflation differentials. So just to recall something that we should know very well from level 1, I, being the nominal interest rate, is equal to R, which is the real interest rate plus expected inflation, right? Nominal rate is the real rate plus expected inflation. In level 1 quant, we said it's the real rate 1 plus the real rate multiplied by 1 plus the rate of inflation. So it was 1 plus R multiplied by 1 plus INF inflation. Here we're just simplifying it to plus. Don't get too confused about it. It's just different authors and different approaches will use different methodologies to get to the nominal rate. It really doesn't matter. So it's just the real rate plus expected inflation. So if an interest rate is made up of a real component and an expected inflation component, an interest rate differential should be made up of a real differential and an expected inflation differential. So if the domestic interest rate is made up of a real component and an expected inflation component, and a foreign interest rate is made up of a real component and an expected inflation component, the differential should be made up of a yield spread, the real interest rate differential, and an inflation differential between the two countries. Now, notice we're adding them. So we have the differential in the nominal rate is equal to the differential in the real rate plus the differential in the expected inflation. Now, since we observe the nominal rates, we can observe the nominal rate in the foreign market and the domestic market. We don't observe real rates. We only observe the nominal rates. So let's change it around so that we're solving for the real interest rate differential. The real interest rate differential will be what we can observe, the nominal interest rate differential minus the expected interest rate differential. This is the inflation differential. So far, I think you understand what's going on here. So let's just look at the term we have in brackets. From uncovered interest rate parity. We know that the difference in this term right here, we're not looking at the whole thing, looking at this term right here and this term right here. So I got confused with the arrows pointing this term. So let's look at this first term. This is the nominal interest rate differential. From uncovered interest rate parity, we know that the interest rate differential equals the expected change in the spot rate. From purchasing power parity, this term over here, we know that the inflation differential equals the percentage change in the expected spot rate. Well, these two things look like they're saying the same thing, right? So that the real interest rate differential is equal to the expected change in the spot rate, the expected percentage change in the spot rate, minus the expected percentage change in the spot rate, which equals 0. So, if both uncovered interest rate parity and ex-ante purchasing power parity hold, the real yield spread should be 0. That's why it's called real interest rate parity. That once we look at the nominal interest rate differential between two countries and we adjust it for the inflation differential, the real rate should be the same. That the market will price these nominal rates to reflect these inflation rates so that the real rates are identical. That is what the Fisher effect in real interest rate parity is saying, is that there is parity in the real interest rates. All right, let's wrap up the Fisher effect here, and then we'll say some concluding words before we move on. This is the conclusion we ended with real interest rate parity, which says that real interest rates are equal across markets. That implies this equality. So let's break this down. What do we have? And we've seen this before. What do we have on the left side of the equality here? We have the foreign domestic nominal yield spread. And over here we have the foreign domestic expected inflation differential. And it's saying that the nominal yield spread will be solely or entirely determined by the expected inflation differential. And that is called the international Fisher effect. This right here is what is referred to as the international Fisher effect. So let's say something about these three learning objectives we just went through for international parity relations. We covered E, F, and G, and we'll sum it up with a few statements here. There's not a lot here that we can work with in the short term or in the intermediate term. However, empirical studies do have something for us. There exists an interaction between nominal interest rates, exchange rates, and inflation rates across countries over longer time periods. So in the long run, well, that's something. That is something. Therefore, international parity conditions serve as an anchor. Remember, I said I don't like the word anchor. I like attractor point. Serve as an anchor or attractor point for longer-term exchange rate movements. So, if we're looking to forecast the direction of exchange rates, maybe we don't know what is going to happen in the short term, but if we can determine what a long-run equilibrium level is for an exchange rate, we can at least determine based on that whether our currency that we're looking at, whatever exchange rate, I shouldn't say the currency because they're traded in pairs, whatever exchange rate we're looking at that is currently overvalued or undervalued relative to that level. And perhaps if we can identify what the longer term attractor point or the anchor term is, the long-term equilibrium point, we can then start to talk about predicting perhaps fluctuations around that equilibrium level. And we're going to see that there are models that attempt to do that. All right, let's go through some of the problems that are in one of the blue boxes here. And I believe I'm in box number, example 5. An Australian-based fixed income asset manager is deciding whether to allocate money between Australia and Japan. Australia's one-year deposit rates are 5%, Japan's are 1%. The Australian dollar is estimated to be roughly 10% overvalued relative to the yen based on PPP. All else equal, which of the following events would restore the Australian dollar to its PPP value? And we have 2 comments about the inflation rate and 1 about the exchange rate. So we're in Australia, so the Australian dollar is the domestic currency. So the foreign currency is the Japanese currency. So if we look at what purchasing parity would say, it was looking at inflation differentials between the two, right? And if they widen, that will cause a greater dislocation in the currency rate. If they shrink, it'll bring them more in line. So let's see what happens. The Japanese inflation rate increases by 4%. So if this went up by 4%, would this widen or shrinken? or shrinking? Would this widen or shrink? This would widen, so that would make things worse. So we can discount that. The Australian inflation rate decreases by 10%. Well, if this decreases by 10%, will this widen or shrink the differential? It will widen the differential, so we can get rid of that. Notice in the question we're talking about interest rate differentials, and then we brought in the idea that it was overvalued according to PPP. So all we're left with is the exchange rate declines by 10%. The exchange would have to be declined by 10%. If the Australian dollar is estimated to be roughly 10% overvalued, then it would have to decline by 10%. There we go. We could have eliminated the first two just by realizing that both of these actually lead to an increase in the expected inflation spread, not a decrease. Number 2. If both the Australian and the Japanese CPI price levels increased by 5%, all else equal, then the change in the real exchange rate would be closest to. And you'll recall our formula for the real exchange rate was the spot multiplied by the ratio of the two price indices, the two CPIs. So what do we have in here? Well, we're being told that both of them are increasing by 5%. So if they're increasing by 5%, they'll just cancel each other out. We'll be left with just 1 in the ratio. Well, the spot multiplied by 1 is just the spot. It doesn't change. So the real rate before the change and the real rate after the change would be identical, because it doesn't matter what CPI what the CPI levels were to begin with. If you're adding a constant amount to each one, nothing is going to change. You're going to get 0%. If real interest rates in Japan and Australia were equal, so the real interest rate are equal, implies real interest rate parity. Then under the international Fisher effect, let's make sure we know what that is. That is we're talking about nominal rates now, IF minus ID. Is determined by the expected inflation rates in each country. That's the international Fisher effect. The international Fisher effect, the inflation rate differential between Japan and Australia would be closest to. So what would this term be closest to? Well, we know that the interest rate differential is 4%. Japan is 1%, Australia is 4%. The interest rate differential is 4%, and actually if we follow along here it would be negative 4%, but we're just going to put absolute values in here because we're just looking for the differential period as opposed to the differential from one perspective or another. So we know it's 4%. It has to equal 4% because we're saying under the international Fisher effect, which is this condition here, it would have to equal 4%. Number 4, according to the theory and empirical evidence regarding purchasing power parity, which of the following would not be true if PPP holds in the long run? So we're looking for a false statement, so we're going to reject any true statement. A, an exchange rate's equilibrium path should be determined by the long-term trend in domestic relative to foreign price levels. Well, that's a true statement. That's exactly what PPP is saying. So that is a true statement. We can reject that because we're looking for a false statement. Deviations from purchasing power parity might occur over short and medium-term periods, but fundamental forces should eventually work to push exchange rates towards their long-term PPP path. That is a true statement, so we can reject that. We must accept C. Let's just read it and verify. High inflation countries should tend to see their currencies appreciate over time. Purchasing power parity is not saying that. It's saying that they would depreciate over time. So this would be a false statement. We're looking for a false statement. We must accept that. Number 5, which of the following would best explain the failure of the absolute version of PPP to hold? What was the absolute version? Remember, we went from talking about the price of a particular good in countries, whether it be in foreign or domestic, to the price level within each country. That is a sub D and CPI sub F. We also denote it as PD and PF. So we went to the price level, and I said there are issues with the price level. It assumes that the constituents of the index are identical along with their weightings. So let's see if there's something in these answers that lean towards that. Inflation rates vary across countries. Real interest rates are converging across countries. Trade barriers exist, and different product mixes are consumed across countries. There we go. If that is the case, that best explains the failure of absolute version PPP to hold. Remember, I said if it doesn't hold, it must be one of two things: either the components of the index are different, or the weightings are different. There we go. C. So let's just end this section by looking at Exhibit 4. You'll find this in your reading, Exhibit 4, and I think it does a really great job of putting it all together. In fact, I think it's one that you can probably just make notes from and get the majority, well, I'd say everything that we've covered so far is captured in this nice little exhibit here. So let's just make a statement up front. Before we go through all the boxes, we'll just make a statement up front. And what we've learned so far, and it's a big if, but if all the key international parity conditions held, the expected percentage change in the spot exchange rate would be equal to the forward premium or discount, this box over here, expressed as a percentage. It's the forward premium or discount over the spot, so it's expressed as a percentage, which should also equal the nominal yield spreads between countries, which is this box down here, which should also equal the difference in expected inflation rates between countries. If they all held, everything would fall together nicely, so that we'd have a very strong relationship between nominal interest rate differentials, between expected inflation differentials, between the expected percentage change in the spot rate. All three of these things would be related very tightly. If that's the case, if that is the case, come all the way down to the bottom here. If all conditions held, it would be impossible for a global investor to earn consistent profits on currency movements. But we're going to go into a topic next called the carry trade, which shows that it is possible to earn consistent profits on currencies. So we've already said, as we looked at the uncovered interest rate parity, as we looked at ex ante PPP, as we looked at the international Fisher effect, we've already found that in the short and midterm, yeah, they don't do a very good job at all. In fact, in the short term, you'll go crazy trying to figure out why none of this stuff works. It simply just doesn't. And when it does, it's not because the relationship just happens to be strong. It's just a currency has to move in one of two directions. So if the theory says it's going to move in one direction, you got a 50-50 chance that it'll work, but it technically doesn't, or typically doesn't. The only one that really holds is number one down here. So let's start over here in this bottom corner. This is the covered interest rate parity. What we have is the nominal interest rate differential and the forward discount or premium expressed as a percentage. Arbitrage makes this happen. When we move from a covered position to an uncovered position, what it's saying is that the percentage change in the expected spot rate should be directly related to the nominal interest rate differential. We find that this does not hold. However, if it holds, if covered and uncovered holds, we move up to number 3 here, if 1 and 2 hold, then the forward rate is an unbiased predictor of the future expected spot rate. It would be an unbiased predictor. This holds. If this also held, then this premium or discount that we arrive at would be an unbiased predictor of what this percentage change in the expected spot rate would be. We see that it's not. Let's move over to this side. So we've got covered. We've covered, right? We're pretty good on the covered interest rate parity. I think we get uncovered interest rate parity. Ex ante purchasing power parity, PPP. This relates the percentage change in the expected spot rate to expected inflation differentials across countries, and that the expected spot rate should reflect this inflation differential. The international Fisher effect ties nominal interest rate differentials and expected inflation differentials together into a real interest rate, arguing that these two equated will result in real interest rate parity, and that's what we should be looking at, is bringing these two together and looking at the real interest rate. If And here's another one, right? If ex ante PPP and the international Fisher effect hold, it implies, number 2, it implies that the uncovered interest rate parity holds, and we're back to this. So all of it ties together very tightly. We can accept 1. If we accept 2, then we accept 3. If we accept 4 and 5, that also strengthens number 2. It says, well, then you must accept 2 because that is a condition. So all of it tied together doesn't work. I know it's unsatisfying. Look where we are, screen 25. It doesn't work. It doesn't work in the short and midterm, but in the long term, ex ante PPP tends to gravitate or tends to kind of show out in the empirical data. Anyways, I don't know how satisfying or unsatisfying that was. I know it can be quite confusing sometimes, but I think that everything can be summed up here. There are 4 relationships really that you need to get out of this section. The covered, well, that's an arbitrage argument. Uncovered, that's theoretical. It doesn't hold. Uncovered is basically getting rid of the cover and saying the market will make it so. There's ex ante PPP and the international Fisher effect. One is nominal interest rate differentials. The other is inflation differentials. This one is both of them together to come up with real interest rate parity. There we go. All right, let's try our hand at a few questions here, 5 questions before we actually hit the carry trade section. Number 1, which of the following is a no arbitrage condition? Real interest rate parity, covered interest rate parity, or uncovered interest rate parity? Covered interest rate parity. No arbitrage condition. In other words, the resulting condition that you arrive at results in no arbitrage opportunities. And real interest rate parity and uncovered interest rate parity do not have an arbitrage condition attached to them. Forward rates are unbiased predictors of future spot rates if 2 parity conditions hold. Which of the following is not one of these conditions? Real interest rate parity, covered interest rate parity, or uncovered interest rate parity? Forward rates are unbiased predictors. Remember, there were that little diagram we went through. We had 4 boxes connected like this, and number 1 over here was covered interest rate parity. This relationship was uncovered interest rate parity, and this is condition number 3 over here. And I said if 1 and 2 hold, then the forward rate is an unbiased predictor of the future spot rate. So what are the 2 parity conditions? Covered interest rate parity is one of them. Uncovered interest rate parity is the second. Real interest rate parity, that's down here on the Fisher effect, right? So which of the following is not one of these conditions? A is not one of these conditions. Number 3, the international Fisher effect requires all but which of the following to hold? Ex ante PPP, absolute PPP, or real interest rate parity? So on that one, we were looking at this side of the diagram between here and here. This was IF minus ID. This was expected inflation minus, foreign expected inflation minus domestic expected inflation differential. This is ex ante PPP, and this is real interest rate parity. So absolute is the one that we do not need. It requires all but which of the following to hold? Absolute PPP. Number 4, the forward premium discount is determined by nominal interest rate differentials because of the Fisher effect, covered interest parity, or real interest rate parity. So if we put this one here, the forward premium discount is determined from this leg over here. This was covered interest rate parity. This is the nominal nominal interest rate differential. This was the forward rate minus the spot rate. And of course, in here we expressed it as a percentage. So this is the forward premium or discount. It's determined by nominal interest rate differentials, which is down here, because of, and what leg is this? This is covered interest rate parity. So I say if you can remember this little chart here, if you can remember this, you can answer all these questions by just redrawing this out and understanding what was in the box, and each leg connected each of these things. So if you can remember this one, all these questions will be really easy. And everything we just did in that whole section can be summed up, like I said, in just that exhibit. Draw that exhibit out 5-6 times till you get it, and you'll get these questions easily. All right, number 5, if all the key international parity conditions held at all times, then the expected percentage change in the spot exchange rate would equal all except which of the following. So there were three things that we said that the expected, we'll draw it out again here. This is the expected percentage change in the spot exchange rate would equal 3 things. We said that it would equal the forward discount or premium expressed as a percentage. We said that it would equal the nominal interest rate spread, and we said that it would equal the expected inflation spread between the two countries. So the real yield spread, well, I don't see a real yield spread in there. We can stop right there. That's our answer, but let's just keep going. The nominal yield spread, there's the nominal yield spread. So yes, we said that it would, so we can eliminate that. That's not the right answer. We're looking for all except. So we're looking for a false statement. B is a true statement. The expected inflation spread, well, there's the expected inflation spread there, so we can eliminate that because it's a true statement. It is the real yield spread. The nominal interest rate spread is there, the expected inflation rate spread is there, and the forward discount or premium, expressed, of course, as a, that is not, let me correct my problem here. That is a percentage of the spot. So those are the three qualities if all parity conditions held at all times. Okay, we're going to move on to a new learning objective now, LOSH. Our keyword here is to explain approaches to assessing the long-run fair value of an exchange rate. And that's sort of what we've been doing with parity conditions. And we have found, or at least we sort of learned, that one relationship seems to hold merit in the long run, which is purchasing power parity, that it tends to have some predictive power of a currency's fair value over long periods of time. So that may be an appropriate model. However, there are observations of significant and persistent departures of exchange rates from what that long-term fair value would be. So is there anything else we can use other than parity conditions? Are there other approaches that can be used to assess the long-term fair value of an exchange rate? The IMF does a lot of work in this because one of their mandates is to keep an eye on currencies for all their member countries to make sure that nobody's trying to gain an unfair advantage by manipulation. So there are 3 approaches that the IMF takes. Actually, it's the IMF consultative group on exchange rate issues. And they use a 3-pronged approach to derive long-run equilibrium exchange rate assessments or assessments of fair value, moving outside of the parity relationships that we looked at. So this is different from that, and all 3 they're related quite closely. Especially number 3. When we look at the third one, it's a combination of the first and the second. So let's look at these, and briefly, what they deal with are a country's current account and their capital account. And we've already learned in level 1 that the balance in the current account and the balance in the capital account must sum to 0. So if you have a positive amount in your current account, you have a negative amount in your capital account. So the first one is called the macroeconomic balance approach. And what it does to arrive at a fair value or an assessment of what a long-term equilibrium value for a currency is it estimates how much the exchange rate or exchange rates need to adjust in order to close the gap between the medium-term expectation for a country's current account and balance and that country's normal or sustainable current account imbalance. So if a country is running a persistently high current account balance or persistently low current account balance that is considered unsustainable, they sort of arrive at some assessment of what the long-term fair value of the exchange rate would be, such that it would bring the current account back to more normal or sustainable imbalance. So the focus here is on real flows, because we know the current account is imports, exports, goods and services, right? Well, the next approach is called the external sustainability approach, and it deals with the capital account. The focus is on stocks of outstanding assets or debt. And here, an assessment of a long-run equilibrium fair value on a currency is how much the exchange rates need to adjust to ensure that a country's net foreign assets to GDP ratio or net foreign liability to GDP ratio stabilizes at some benchmark level. So the focus here is on financial flows, and we're not going to get into detail about how this is done or what definition of benchmark level are they using, what is the benchmark level. This is more of an explain the different approaches. So we've got a capital account, a current account focus, and we've got a capital account focus. The third one says, well, don't just use one or the other, combine them. So let's have a look at that. All right, the third one is the use of a reduced form econometric model. It seeks to estimate the equilibrium path that a currency should take on the basis of the trends in several key macro variables. Net foreign asset position, this is just examples of some of the terms. Net asset foreign position, there's capital account information. Terms of trade, there's current account information. Outside of that, things like relative productivity. So it uses an econometric model. It uses some of the elements from the macroeconomic approach and the external sustainability approach to determine what a long-run equilibrium value would be under that direction. Notice that 1, 2, and 3 are not talking about parity conditions at all. We're moving away from that. So how do those work? How well do they do? We've seen that parity in short to medium term conditions, most of them don't hold. The only one that really seemed to hold out some promise was purchasing power parity. Well, let's look at some empirical observations from these approaches. Have some predictive power. I know that looks like productive. What I'll do is I'll get rid of that O and I'll put an E in there just to be very clear that it is predictive. They have some predictive power regarding future changes in exchange rates. But while they can predict direction, so that they can look at overvalued and undervalued currencies, and they can identify over and undervalued currencies, and point to either an appreciation or depreciation, they really suck on magnitude. When I say that they have some predictive power regarding future changes in exchange rates, I should be really accurate here and throw in the proper modifier here, real exchange rates. In real exchange rates, they can predict direction, or it's shown that they have some power to predict direction, but poor on magnitude. And they also tend to overpredict. So if there is a currency that's extremely undervalued, the prediction of a rise, they tend to overpredict, and in actuality, it never really quite gets there before it starts to become undervalued again. Same in the other direction, when it's overvalued and they expect it to drop, it doesn't quite drop as far as they anticipate, or as the prediction would say. The international parity relations specify the relationships between, as we've seen, nominal exchange rates, expected inflation rates, and the exchange rate itself. The three approaches we've looked at here, dealing with the current account, the capital account, and a combination of the two, attempt to explain some of the mechanisms that help realign exchange rates. And as we go into some of the later learning objectives, we're going to go into the idea of the capital account and current account a little bit more in a little while. So I don't want to do too much here because we're going to get to it anyways. And we're going to see exactly how these changes in the capital account and current account will force, not so much force, but will encourage exchange rates to move in one direction or another. They almost they're almost The exchange rate is almost a self-correcting or a stabilizing mechanism for current and capital account imbalances. And I say almost, because there's a lot of things at play with currencies. But typically a country that has huge trade deficits will eventually see their currency weaken because of it, and that weakening will make their exports more attractive on the world market and will make imports more expensive, thereby self-correcting that imbalance. So it gives us a mechanism by which exchange rates change. When we looked at the parity conditions, we saw the relationships, but there really wasn't a mechanism in there. There was just a statement saying that parity in these conditions will be reached. But how? There was the mechanism by which, A leads to B wasn't very clear, or it wasn't very satisfying. These approaches tend to make the mechanism more upfront and saying, look, okay, here's how they're going to adjust. They're going to adjust by this method. And we'll look more into that later. We just wanted to introduce this learning objective, just short enough. It's just to explain those three. I think you can do that. Okay, before we leave this learning objective, there's in the reading, if we look at example 7, long-run equilibrium exchange rates in the blue box, I think this is a kind of a neat little thing they've done in this respect. Is look across the top. We have one method of assessing what the long-term fair value of a currency is. And perhaps purchasing power parity can identify a currency as overvalued or undervalued. There's one approach. Using the one of the three approaches we just talked about, we'll use the current account method, the macro method. We have a current account surplus or a current account deficit. And we'll combine them with PPP. So if we cross them, do they say the same thing? Do they confirm each other, or do they compete with each other? And when they confirm or compete, what do we do? So out of the four here, we have number one is an overvalued currency with a trade surplus. Number two is overvalued currency with a trade deficit. And then 3 and 4, we have an undervalued currency, both with a trade surplus and trade deficit. So let's look at 2 and 3 because they're the easier ones to look at right away, is 2 and 3. If we have a situation where using PPP to assess a long-run value of a currency, we find that we have a currency that's overvalued compared to its long-term equilibrium rate, and the country is running a current account deficit, do they agree with each other? And what would be the action required to bring the exchange rate closer to the long-run fair value? Well, when we're running a current account deficit, remember our balance of trade is our exports minus our imports. If we're running a current account deficit, it means this term is negative, so imports must be greater than exports. So we're importing more than we're exporting, and PPP says we have an overvalued currency. Would that make sense? Well, if our currency is very strong, the relative price of imports is very, very low. But the relative cost of our exports are very, very high because others have to buy our expensive currency to buy the product. So that is consistent. There is consistency here. So under both approaches, we would say, well, you'd want to encourage exchange rate depreciation or currency depreciation. That's exactly what we could do, is you could encourage depreciation, because if it's overvalued, you need the currency to drop. By dropping the currency, by depreciating the currency, you can fix this current account deficit. Let's look at number 3. It's quite the opposite. We have an undervalued currency and we're running a current account surplus. And of course, working off this same relationship here, we'll just redraw it. We have X minus M for our current account, or for our trade balance. And if we're running a surplus, it's positive, which implies that our exports are greater than our imports. And if we have an undervalued currency, that is consistent because the value of our exports are cheap on a relative basis on the world market. But imports are going to be expensive from a domestic perspective because we need so much more of our currency to buy on the international market because we have an undervalued currency. So the policy prescription in this particular case is also clear: encourage appreciation. The problem comes in the other diagonal in this particular way, 1 and 4. when they're at odds with each other. So number one, we have an overvalued currency, which says that we should encourage depreciation, but we have a current account surplus. So to narrow that surplus to bring it to something that's more sustainable in the long run. A country can't run a consistently large account surplus for a long period of time, or a deficit for long periods of time. We just said that what we'd want to do is encourage appreciation of the dollar. So under this approach, we would say the currency needs to appreciate, but it's already overvalued from a PPP perspective. So what do? Well, it's unclear. We don't have a clear path. And the same with 4. PPP suggests that the currency should appreciate, but we've already said that if we have a current account deficit, we would want to depreciate the currency, but we'd be depreciating an undervalued currency. So there again, the path is sort of unclear. So we can use a parity approach, which may tell us one thing, and we can use one of the IMF approaches. This is the macroeconomic balance approach with the current account, which would tell us one particular thing. When they're in agreement, everything seems fairly straightforward, but they don't necessarily have to be, which then sets up the question of, well, which one, what do we do? Which path do we follow? All right. Next learning objective here, LOSI. A word about LOSH. Maybe you feel I've left that a little too quickly. There's a section in the reading that goes on to develop a model that I've just basically skipped altogether, if you've noticed it. I'm not skipping it. I'm deferring it. It fits better with our next learning objective, which is to explain how flows in the balance of payment accounts affects currency exchange rates. So I'll introduce the model there, because it fits in with what we're talking about there. But if I introduce the model in the last learning objective, it just introduces the model without anything more, and I felt that, well, then what? What do we do now? So I thought, you know what, this was better introduced in the section where we'll actually use it. So don't worry, I haven't shortchanged you on the last learning objective. The last learning objective really was just to explain the approaches. I explained the approaches. We'll dig into them after we jump over the carry trade here. So let's look at this. UIRP, uncovered interest rate parity, says these things. High yield currencies are expected to depreciate and low yield currencies are expected to appreciate. That's what we get from UIRP. But there is significant evidence that UIRP does not hold over short and medium term time periods. Well, now we're getting somewhere. That's excellent. When we talked about parity relations, we talked about their complete failure in the short and medium term, but that sometimes in the long term it seemed to maybe there's something here. But now we have something specific. We're saying here that it does not hold over short and medium term time periods. So these two conditions do not hold. Beautiful. We can use that now, because if they did hold, there'd be no carry trade. There'd be no such thing as a carry trade. But because we know that they do not hold over the short time, that gives us window of opportunity. Let's open that window and see what we find. Opens up a strategy, a trading strategy called the FX, or the foreign exchange carry trade. Take long positions in high yield currencies and take short positions in low yield currencies. These low yield currencies are called the funding currencies. I want to be clear on this carry trade business here. Look at this. I want to be clear. These are plural. So a carry trade is not a matter of finding a currency that is low yielding and a currency that is high and trading that pair, and just that pair. What we're looking for is a basket of low yielding currencies and a basket of high yielding currencies, and setting up a trade like that so that we borrow from the low yielding currencies and we invest in the high yielding currencies. Earns positive excess returns in most market conditions. Now, what do we mean most market conditions? Low volatility conditions is what we mean by that. And here's the problem with the carry trade. This is the big threat to the carry trade. Volatility or perceived risk can cause these positions to unwind fast. Fast. And that's it's referred to as crash risk. So that word right there should send the message, crash risk. And there are situations where when these have happened in the past, hedge funds that could not unwind their carry trade fast enough or that waited too long were basically brought down, have disappeared. When there is a carry trade that makes sense, a lot of participants do it. That's called a correlated strategy. And correlated strategies, if you're late to one of these strategies, the margins get thinner and thinner and thinner as you go on. The first ones in have the best margins because the carry trade over time forces an overvalued currency to become more overvalued and an undervalued currency to become more undervalued. You run the risk of pissing off the central bank. There might be central bank intervention. And if they do intervene, the exit is ugly. Carry trades will use considerable leverage. And that's just the truth of currency markets is they are highly leveraged. They're the most leveraged market. There used to be a time when you could get 200 times leverage on your position, but leverage runs around 50 times. Typically, you can get leverage of about 50 times leverage. Or I know that with Interactive Brokers, I think their leverage is 40 times leverage. So if I want a $100,000 position on a currency, I really only need $2,500 to make it happen. So with $25,000, I can control $1 million in the currency market. But there used to be times, I think going back before 2007, 2006, somewhere around that time, where you could get up to 200 times leverage. Isn't that crazy? So you can imagine when these things start to unwind because they're so leveraged, how fast they would unwind. Sometimes you to avoid potential problems in setting up your carry trade, you can use a volatility filter. And this works as follows. If the average level of Forex volatility falls below some threshold, you open up the carry trade positions, which may be accompanied by some other volatility measures. Perhaps you have equity market volatility measures as well, not just foreign exchange volatility measures. If the volatility rises above some level, close your trade positions. So you might say, listen, I'm not going to get caught off guard with this. I'm only going to open up a carry trade position when volatility is below some threshold level. And if it rises above some threshold level, certainly not near the level that would cause trouble, but if it starts rising and gets above some level, well, I'm out. And you could set those levels to whatever you feel comfortable with. You could use purchasing power parity in combination with your carry trade decisions to determine which currencies to choose or not. Remember, I said you're going to choose a basket of high yield currencies and a basket of low yield currencies. So with purchasing power parity, you can get some idea of which currencies are currently overvalued and which currencies are currently undervalued. So you may set an upper band on PPP saying, listen, I don't mind buying overvalued currencies, but if they're too overvalued, I don't want them. And I don't mind shorting undervalued currencies, but if they're too undervalued, I don't want them. Typically, your overvalued currencies will be your high-yield currencies. Your undervalued currencies will be your low-yield currencies. So you'll have an upper and lower band. And within this band, there'll be some currencies left in here. You'll go long the high-yield currencies and short the low-yield currencies, and you'll avoid any of the currencies which are above the upper band on overvaluation because there's an increased risk of depreciation up here. And if you're going to be long this currency, you don't want that depreciation. And you'll avoid the ones that are below the lower band because they're very undervalued. So you have an increased, decrease. I was thinking the arrows up and down. Let me write that arrow in a little bit better. You have an increased risk of appreciation in the currency, and if you're going to be short that one, you certainly don't want that. So you would select your currencies based on them being within a certain, you don't mind them being overvalued, but if they're too overvalued, ignore it. Same with the undervalued. from a policy perspective, the carry trade can be a real pain in the ass. And Japan found this out when their yen was sitting around 2010, 2011. I can't remember the year, but the yen was bouncing on a valuation perspective at 80, bouncing off of 80, threatening to break under 80. That means the yen is strengthening against the U.S. dollar, and it did. And when it broke under 80, there was a flood of orders sitting under 80. Get me out, get me out, because it was appreciating. It was a low yielding currency that was appreciating. It was very, very odd, and that kills a carry trade. So get me out. And it went all the way to 76, and the central bank said, listen, we can't have that. So I remember it was a Thursday night at 9. They had organized with a bunch of other central banks to intervene, and they drove the yen from 76 all the way up to 83, 84. That didn't hold. The market, as soon as the intervention was done, the market drove it right back to 76. And then that's finally, I think about a year later, is when they decided, let's just print and print and print and devalue the yen. And where is it now? 118. So from a policy perspective, there's concern that carry trade activities may be generating forex rate misalignments. Unwinding a large carry trade could cause a financial crisis. So there are some emerging market countries that typically have higher interest rates than developed countries. So when a carry trade is on, they find that their currency gets pushed to ridiculous levels. It gets completely overvalued. Well, when it's overvalued, emerging market economies tend to rely more on exports than imports. They need to export, which means they'd like an undervalued currency. And they have their interest rate set high because they are trying to get price stability. They're dealing with that inflation rate. They want to keep inflation low, so they got to keep interest rates high. If they drop interest rates to affect the currency, they would actually increase the inflation rate and hurt their own citizens. So they're sort of in a catch-22 because of this carry trade. And when it does unwind, it could drop their currency so quickly, so fast that the country lacks the ability to adjust quickly, which then could cause a financial crisis in their market, not of their own doing. Now, if a country suffers a financial crisis because of their own actions, that's their own fault. But when it's not of their own doing, when it's just hot money flowing into their country simply to ride a carry trade and then run away as soon as things change, well, yeah, you can't really blame countries for instituting capital controls under those situations. All right, and we'll end this section with the second keyword here, which is to calculate. And we were asked to calculate the return or the profit off of a carry trade. And this one I'll take right from the blue box here, example 8, carry trade strategies. I'm not going to cover the first 4 questions. This goes to question number 5. A Tokyo-based asset manager enters into a carry trade position based on borrowing in yen and investing in 1-year Australian LIBOR. So we can see the 1-year LIBOR rate on yen and the 1-year LIBOR rate on Australian dollars. We have some currency pairs, but we don't have the cross pair. The yen Aussie, we have the yen US and the US Aussie, and we have the current, the 1 year, the 1 year ago spot rates at the time the trade was entered into, and then we have the current spot rates now that the year is over. So the asset manager based in Tokyo is going to borrow in yen and sell or invest in 1 year Aussie. So they'll be selling yen and buying Australian dollars, and then and investing in the Australian LIBOR rate of 4.5, and at the end of the year converting back into yen and hoping that the higher yielding currency will either stay the same or go higher, and that the lower yielding currency will drop. And let's have a look and see if that actually happened. We can see the Australian dollar against the US 107.50. 1 Australian dollar was able to buy 1.075 US. A year later, it was able to buy 1.08. So the Australian dollar did, in fact, strengthen over that period of time. But the yen strengthened as well. 1 US dollar bought 81.3 yen. A year later, it only bought 80. So the yen got stronger because the US dollar is buying fewer of them. So In this case, one of the legs worked out well. The high-yielding currency appreciated, so there'll be some appreciation plus the higher yield. On the yen, you do have the lower borrowing costs, but you did have some strengthening. So I know right away we're not going to get 4.5%. We're going to get something less than 4.5 because we lost on this leg here. But the gain in the Aussie might offset the gain in the yen. We don't know, but it looks like there was some currency difference that will change. Typically, we would just say 4.5 minus 1. There's a potential of 4.4% just on the interest rate differential. What happened to the exchange rate? So let's calculate this. So we're borrowing in yen. We're investing 1 year in Aussie LIBOR, and after 1 year, calculate the all-in return of this trade. Well, we need a cross rate first of all, because we got to figure out what the cross rate pair was at this point in time and 1 year later. So we notice that the US dollar is opposite on each of these, so all we have to do is just multiply the two together, and the US dollar is going to cancel out here and cancel out here, and we'll be left with yen over Australian. So to get the cross rate, we'll take the two pairs and multiply them. So originally we had 81.30 and 107.5 for 87.40. 1 year later, we have 80 times 108.03 or 86.42. Notice we're not using bid and asks here. We're just simplifying the question because we're really just getting to the to see how do you calculate the carry trade. So we're just going to assume, well, maybe these are mid-market quotes. So this is what we originally entered the trade at, 87.40, and this is what we exited at. So what is this saying? This is saying that it cost us 87.4 yen to get 1 Australian dollar. And at the end of the year, 1 Australian dollar is only going to get us 86.42 yen back. We're not going to get the 87.4 back. And since we're just looking for a return, we're going to assume we did this, that we bought 1 Australian dollar. That's all we're going to assume. We don't need an amount because it's a percent, right? So here we go. Our 1 Australian dollar at the end of the year will be 1.0450 Australian dollars. And if you multiply it by this ratio, this is 86.42 over 87.40. This is the end of the year, beginning of the year. This will give us a return in terms of not a percent, but if they were equal, that would be 1.00. If it were greater, it would be 1 point, let's say it ended up being 1.02. We know that there's a 2% appreciation. If it ends up being 0.98, we know there's a 2% loss. So we're just going to put it in this ratio like this and multiply it by the amount of Australian dollars we have. Another way to think about it is, this is how many Australian dollars we have. 86.42 is how many yen we get per Australian dollar. So if we multiply that out and divide it by the original amount, it'll give us a percentage return. Right? That's the how many yen we have at the end of the year. This is how many yen we invested at the beginning of the year. We'll get a percentage amount. But we have to figure out the all-in price. Notice our borrowing costs here were 0.1%. So we have to subtract whatever we get. We have to subtract 0.001 from that. So we get 1.033283 minus 0.001 gives us 1.032283, and of course we would be subtracting 1 from this. This is roughly 3.23% in the end. So our all-in return of this trade is 3.23. Notice we had 4.5. A 4.4% differential between the two, but we only ended up with 3.3 because of the currency move. When we have a differential like this, the thing you can do before you even enter the trade is you can calculate the maximum currency exchange movement, negative exchange movement that you can handle before this trade would before the currency would wipe out the differential on this spread. So you can do that, and then you can ask yourself whether or not that seems reasonable, and then you can set your stop losses on the currency on either on that particular pair, such that when it gets to that particular amount over some particular time period, it would just stop you out, and you would be done. And there we go. That'll wrap up carry trade. Let's move on to our next learning objective. All right, we're on a new learning objective now, LOSJ. Our keyword here is to explain, and I think you can see from the title, balance of payments impacts. But I'll read it out. Explain how flows in the balance of payment accounts affect currency exchange rates. And we sort of alluded to this in an earlier learning objective, after we had gone through all the international parity conditions, we spent some excruciating time there, only to come to the conclusion that in the long term, purchasing power parity held some promise. So we looked at 3 other assessments of exchange rates on the exchange rate equilibrium levels. The macroeconomic balance approach, the external sustainability approach, and a reduced form econometric model. And there we introduced elements of the capital account and the current account. Well, here we go right into that. We explore that in more detail and look at the impact of those flows on the exchange rate. Real flows when we talk about the current account, and financial flows when we talk about the capital account. So I'm going to repeat some stuff from level 1 just to make sure we all have the right vocabulary here. The current account, that's the sum of all recorded transactions in traded goods and services, income, and net transfer payments. Countries that tend to run persistent current account deficits typically see their currency depreciate over time, and countries that run persistent current account surpluses typically see their currency appreciate over time. I should add a caveat here. That's assuming the country has a freely floating exchange rate. If it's pegged or if it's fixed, then maybe not. I say maybe not because we'll talk about that later on when we talk about intervention, that even a currency under a fixed rate regime may not be able to hold back the inevitable. So from level 1, we learned that the balance in the capital account and the balance in the current account, the absolute value of the balances, are equal, that they are equal to each other. But while they're equal in magnitude, they're not equal in quality. One flows much faster than another. One responds much faster than another. So in the capital account, we're talking about financial flows, investment and financing decisions. And here's the interesting thing. They are usually the dominant factor in determining exchange rate movements. Now, for some of you out there saying, hang on a second, if they're equal, don't they explain equally? Yes, they're equal in magnitude, but not in character. The capital account, dominant factor in determining exchange rate movements in the short to intermediate term. In the long term, they're equal. In the long term, they'll have the same effect. It's just the capital account has much faster reaction than the current account. So let me see if I can explain why. And there are 4. They offer 4 reasons why, and they're all fairly good reasons when we think about it. Prices of real goods and services tend to adjust much more slowly. Financial assets adjust quickly. So for whatever reason, the prices may be changing in a particular economy. Goods and services tend to not adjust very quickly to different stimuli. We can think of the term menu pricing or the idea of sticky wages. So we know that when events happen within an economy, prices are slow to change. Well, if prices are slow to change, suddenly the trade balance doesn't respond immediately. However, financial assets adjust very quickly. That leads to inflows and outflows. So if prices are changing, interest rates are dropping, whatever the case is, the cash, the financial assets adjust very quickly, leading to inflows and outflows. That impacts the exchange rate, again, in the short to intermediate term. Over the long term, the prices of goods and services will also adjust. Actually, as the exchange rate adjusts, the external price of our goods and services also adjusts, and the external prices of other goods and services will adjust to that. But the actual sticker price on the shelf, they adjust much more slowly. Number 2, very related to number 1, the production of real goods and services takes time. Demand decisions are subject to substantial inertia, or what I like to say is a lot of decisions, production decisions, are path dependent. That once we start out on a particular path, we tend to stay on that path. So let's say that we're a manufacturer of a particular product and we import a lot of our componentry. those import decisions are going to be insensitive for a period of time, regardless of exchange rate movements, regardless of interest rates, regardless of other prices, because we've already locked ourselves into that particular type of supply. So the production of real goods and services takes time. However, liquid financial markets, they respond instantaneous. They have instantaneous redirection of financial flows. So again now, we're not saying that one has a greater impact than another. We're just saying that it impacts it in the short to intermediate term. The capital flows have a more dramatic impact in the short to intermediate term. In the long term, they are identical. Number 3, current spending or production decisions reflect only purchases and sales of current production. What does that mean? Well, let's read the next part and then I'll explain what we're trying to say here. Investment and financing decisions reflect not only the financing of current expenditures, but also reallocation of existing portfolios. So let me break that down for you. Let's say that I am a business that's doing something right now. My current and spending decisions reflect only what I'm doing right now. I cannot change anything I did a year ago. That's already done. However, if I have financial assets and I bought certain financial assets a year ago, well, I can rebalance that portfolio very easily. But it's hard for me to rebalance past spending. That's already done. It's over. So not only will financial flows reflect current expenditures, but any past expenditures that were made could easily be rebalanced again. Number 4, expected exchange rate movements can induce very large short-term capital flows. Now, that's not the point we're making. The point we're making is the next one here, but we're just sort of making an observation here. Expected exchange rate movements. If we expect some movement in a particular exchange rate, just the expectation of the movement can induce very large short-term capital flows. Therefore, actual rates will be very sensitive to the currency views held by the owners or managers of liquid assets. Not so much with goods and services. I may have a particular expectation of where I think the Canadian and the US dollar is going, and it may change the allocation of investments that I have towards Canadian denominated assets or US denominated assets, but I'm certainly not going to start changing my purchase decisions based on what I think my currency views are, unless it moves in an extended period for a period of time where then I must adjust. Typically when importers and exporters adjust to currency rate movements, it's after a prolonged period of movement in a particular direction, and there tends to be a punctuated adjustment rather than a gradual adjustment. It just sort of all happens all at one time as opposed to a gradual adjustment, but over a longer term period. So there we go. That might help explain the statement we made earlier that the capital account is got a greater impact in the short to intermediate term. All right, let's just focus now on the current account. We'll look at the current account and balance and the effect it has on exchange rates, or the effect it has in determining exchange rates. And there are 3 mechanisms that we discuss through which current accounts influence the path of exchange rates over time. The flow supply demand channel, that's the first one we'll look at. Then we'll look at the portfolio balance channel, and finally there is debt sustainability channel. I had a little bit of a brain hiccup there. So the flow supply demand channel. Purchases and sales of internationally traded goods and services require the exchange of domestic and foreign currencies. Now, I should say, for the most part, it does. For the most part, it does. So a Canadian company buying something from an American company would typically have to pay the American company in US dollars. An American company buying from a Canadian company would typically have to pay a Canadian company in Canadian dollars. So if a Canadian company bought from an American company, that Canadian company would have to go to the bank, sell its Canadian dollars to buy American dollars to pay that bill. And, of course, the opposite works for the American company buying Canadian goods. So it creates upward pressure on a currency when a country runs a persistent trade surplus, and it creates downward pressure on a currency when a country runs a persistent trade deficit, because there has to be buying and selling of that currency. So a trade surplus or trade surplus nations, more demand for the currency, therefore upward pressure. Trade deficits, more selling of the currency, therefore downward pressure. Now I say mostly. Here's the big problem with this argument, is a large number of international contracts are denominated in US dollars. So that, for instance, when I lived in Windsor, and there were a lot of tool and die and mold shops in Windsor, heavy manufacturing, that did a lot of cross-border business. The vast majority of their sales were in US dollars. They would quote in US dollars. They didn't quote in Canadian dollars. They quoted in US dollars, and then they took care of any exchange rate fluctuations. So there wasn't so much a demand for the currency from that perspective. And even once they got paid in US dollars, many of them maintained US dollar accounts and didn't actually convert the currency back again. So for the most part, we would expect this, but not always, not entirely. Persistent surpluses or deficits should revert over time. So let's look at this. A surplus country, currency, a country that runs in a trade surplus over a period of time, should see their currency appreciate to a point that exports would drop and imports would increase. So if I'm in a country where the currency is appreciating and appreciating and appreciating, suddenly every other country's imports into our country, every other country's goods seem a lot cheaper because my currency can buy so much more of their currency, imports would rise. But for other countries, our goods got too expensive because to buy our currency, they need more of their currency. So our exports in their prices are too expensive. Their exports, which become our imports in our prices, suddenly just got cheaper, which would then close the trade surplus and open up a trade deficit, which would then put downward pressure on the currency. So the amount of the adjustment that is needed to restore the current accounts to balanced position depends on the initial gap between exports and imports. Substantial currency depreciation if, number one, import demand is more price elastic versus export demand, and two, the wider the deficit gap. So a country with very large trade deficits would have to have significant currency depreciation to close that and switch over to being an exporting country. All right, let's continue on with the amount of adjustment that's needed. It depends also on the response of export and import prices to changes in the currency rate. Typically, as the exchange rates drop, the relative price of imports would increase, the relative price of exports would decrease. However, that doesn't really happen. Empirical results show there's limited pass-through effects of a change in the currency rate on import and export prices, simply because they're typically absorbed or they're hedged away, so that exporters and importers become insensitive to those changes. And C, the response of exports and import demand to changes in export and import prices. So if demand doesn't respond very well to changes in prices, then you'll need an even larger devaluation or a revaluation of the currency to change any of the activities in the trade balance. The empirical results here, demand is quite sluggish. It does not respond very quickly to changes in prices. And many times it's because there might be a supplier relationship that took time to build, and the parts that are being supplied are of a particular type that if you had to change suppliers, it would be quite significant. There may be a lot of cross-border activity across many different countries that are subject to contractual agreements Much of the cross-border activity in Canada and the U.S., by the way, is intercompany cross-border activity, where a part goes back and forth until you got a car. So it may cross a border several times before it's done. So that doesn't really respond very well either. Number two, the portfolio balance channel. Surplus nations will build up foreign exchange reserves to the point where they may say, "Look, we got too much of this stuff. We have to sell our foreign exchange holdings and rebuy back some of our currency." Rebalancing these reserves result in selling foreign currencies and buying domestic currencies. So just rebalancing a portfolio of foreign exchange reserves could drive up a particular currency. And number three, the debt sustainability channel. Persistent trade deficits will result in increasing debt owed to foreigners if levels become unsustainable, and that's the key word there. You can have increasing debt, but it may be sustainable or deemed to be sustainable. If levels become unsustainable, a major depreciation of the currency will be required to rebalance the current account. Not only that, as the trade deficit widens, the debt begins to increase. The amount of debt owed to foreigners begins to increase. If it gets to a point where it's not unsustainable, it's sustainable, but it's quite large, the required rate of return for holding that debt may increase, which may drive up interest rates, and driving up interest rates results in capital inflows, which may push the currency even higher and worsen things. So that's why we have the point here: major depreciation of a currency will be required to rebalance that. And we'll see that exact, not so much that exact, but along the thinking along that lines when we get to the learning objective about intervention and capital controls. All right, let's move on to the capital account and look at that in a little bit more detail as well. Greater global capital market integration has resulted in increased freedom of capital to flow across national borders. So if we go back to the 60s and the 70s, that was not necessarily always the case. It is more so today that you have a lot more freedom, that capital flows a lot more freely than ever before. This can have negative consequences, something called hot money, where money flows into a particular economy faster than that economy can absorb it, which leads to the introduction of capital controls. And let me give you an example of a capital control that is masquerading as helping people out. BC, we have in Canada here, we have a province called British Columbia, which is, if we look at North America as being almost like a triangle here, East Coast, West Coast, BC is the province right at the very end by the Pacific. If we look at Vancouver and look at housing prices in Vancouver, they were ridiculous. Well, they still are ridiculous, but they were ridiculous. So to cool down the housing prices, British Columbia instituted a foreign buyers tax. That's a capital control. It's a form of a capital control. A foreign buyers tax to stop foreign money from coming into the property market, because a lot of money has to leave China, and it has to find a way to leave China because there's fear that at some point, the communist government is going to come and take all our money. So it's trying to find its way out of there, so it's buying property wherever it can. While those capital controls are now in place to try to keep that price down, because it is having a negative consequence. So introduction of capital controls, attempts to prevent capital inflows from pushing currency values to overvalued levels. And not only just currency values to overvalued levels, but asset prices that are deemed either in frothy or bubble territory, primarily because of the inflow of capital from other sources. All right, let's look at some relationships here when we're talking about the capital account. The first one we'll look at is the relationship between real interest rate differentials, capital flows, and the exchange rate. And we haven't really dealt too much with real interest rate differentials. And you'll recall earlier in the video I said that there's a formula that's developed under assessing long-term equilibrium values, that there's a formula developed for the real exchange rate, but that it didn't seem to make any sense to put it there. It just, we develop it and then we sort of just leave it hanging there without really applying it to anything. So rather than have introduced it there, I said I'll introduce it later on. Well, now I'm going to introduce it. So let's just take a minute and look at this ugly looking thing in the middle with all this notation. And it's really not that bad. Let's just focus on the first two terms here. And we'll notice that the notation looks identical except one has a bar on the top. And what we're saying is Q we're going to use to denote the real exchange rate. And of course you have foreign over domestic, which that's the notation we're used to. Q bar means it's the long run equilibrium rate. So the real exchange rate is going to fluctuate around its long-term equilibrium rate. And those fluctuations will be caused by these elements. So let's have a look at what these elements are. RD minus RF. This is the real interest rate differential. This is the differential between two countries, a high-yielding country, low-yielding country. We don't know which is high or which is low. We're just going to say domestic versus foreign. So the wider the spread in favor of the domestic country, so if the domestic country has the higher interest rate, notice that this is additive. So that in the short term, oscillations around the long-term trend. So if we think of the Q bar as being some long-term trend, this term will determine the oscillations around that long-term trend. So the real interest rate differential, notice what I say here, plays a major role. And we'll talk about that a little later, whether or not it really does play most of the heavy lifting, or if it just looks like it does most of the heavy lifting. So we'll talk about that a little later. But for right now, especially in the literature, it's afforded the king's position on this one, that it does most of the work in determining what these oscillations are. And what is this over here? This is a relative risk premium, I think if you've been in markets or have been an observer of the markets, you're familiar with the terms risk on, risk off. That some days are risk off days where money leaves risky assets and looks for safe places to hide. Other days it comes out of hiding and looks to take on risk because it's looking for return. Well, this is the relative risk premium between the two currencies. Perceived sustainability of the country's external balances in the risk premium. So the tighter this spread is, the less it draws away from the real interest rate differential. So on risk on periods where the market is willing to take on risk, the wider this differential, you might get overshooting like this, and you might get undershooting in extreme risk off positions. So the real exchange rate will oscillate around its long-term rate because of these terms. So in short, capital responds to interest rate differentials, risk premia, and expectations with respect to currency rate movements. So this is what when we're looking at real interest rate differentials, capital flows, and the exchange rate, it is the differential. Primarily this interest rate differential between two countries that will determine the direction of capital flows. So a country that has a high yielding money market or high short-term interest rates, high yielding currency, will experience capital inflows, and the real exchange rate will be above the long-run equilibrium rate. So interest rates, what we're saying in A here is the real interest rate plays a role. Let's look at B. B goes on to just the interest rate now and looks at the nominal rate. Because really, what do we see? When we look at interest rates, we see a nominal rate. We don't see a real rate, we see a nominal rate. We can calculate the real rate by adjusting for inflation or inflation expectations, but inflation expectations are unobserved. The exchange rate will reflect it going forward, but it's unobserved. Same with the risk premium, that's unobserved. So when we look at interest rate differentials, and here we'll look at the carry trades and exchange rates. It's you could just change capital flows into carry trades. Capital flows is we can think of that as money seeking out its best and highest return. Carry trade is the same thing, but doing it persistently in the same way, such that a carry trade would end up being a very highly correlated trade, sort of like a well-flowing river. that sort of drags everyone along. So we have the same thing here, right here, where we're saying that the real exchange rate will fluctuate around its long-run equilibrium value because of these terms here. Now notice that this term at the very end is the same. The relative risk premium is the same. But what do we have in here? Well, all we've done was we've taken the real rate and say, well, we don't really see the real rate, but we do see the nominal rate. And we know that the real rate is the nominal rate minus the inflation expectation. Or said another way, if we take the real rate plus the inflation expectation, we'll get the nominal rate. So all we've done, we've taken this and we've broken it into two components. And we've changed the notation a bit. Rather than saying foreign domestic, we're now going to say low yield currency and high yield currency. High yield currency being the base currency, because it is, of course, in the denominator, so we refer to it as the base currency. And again, these foreign domestic, the way we do the notation, it's really just a matter of convenience, right? So we have the low yield and the high yield. So let's see what we're saying in interest rate differentials here. So we're saying that the real exchange rate will rise when yield spreads widen. Between the nominal yield spread widens between the high interest rate country and the low interest rate country. So a country that has high short-term rates versus one that has low short-term rates, if these rates go higher or if these rates go lower, if this spread widens, it will put upward pressure on the real exchange rate. Minus the inflation expectation spread. So the real exchange rate will rise if inflation expectation spreads tighten. If not spreads, the spread, it's singular now. Inflation expectation spread tightens. So that the expectation for inflation in the high yield country either drops or inflation expectations for the low yield country rises. Because keep in mind now, we're taking these two items from the real interest rate spread. We break them up into two. This is a questionable one only because if inflation expectations in a low yielding country begin to rise, the expectation for an interest rate increase also rises, which is why we say that even though we don't explicitly write it out in the formula, expectations with respect to currency movements will affect capital response. So you can get a spread that is tightening, but at the same time that this is tightening, we would think that that should raise the interest rate. This will also begin to tighten because the low yield currency, the expectation is that it will increase as well. And then finally you have your risk premium, if the risk premium spreads tighten. So all we have to do is just look at our notation, right? QL is a function of its long-term equilibrium value plus, well, then if this gets bigger, that goes higher, minus. So obviously, the bigger this is, the smaller this is, the smaller this is. Will affect the, again, the fluctuations around its long-term equilibrium value. So let's talk our way through an example for B, just to see how this equation would tell us what would happen. Let's take the example here of a high yield, high inflation rate country. So we have a country that has high short-term rates but is experiencing high inflation, hence the need for the high short-term yield rates. They're probably still fighting this inflation. The country wants price stability and long-term sustainable growth. They want, mom and apple pie. They want what everybody wants, right? So let's see what this equation would tell us. And we're to achieve price stability and long-term sustainable growth, they're going to follow these two policies here, number 1 and number 2, or these two strategies. I'm not going to call them policies, but these two strategies, strategy 1 and 2. So all I've done is I've replicated the formula here. The real interest rate will oscillate around its long-term equilibrium value through three mechanisms: the relative spread in the nominal interest rates, the relative spread in the inflation expectations between the two countries, and the relative spread of the risk premium in the two countries. And I make a note here. Notice that these are unobservable. We don't actually observe these. We observe the nominal rate. That is why in the literature the nominal rate, or the nominal interest rate differential, is afforded most of the credit for changes in the real exchange rate around its long-term equilibrium value. This may be doing a lot of work, which then changes this, which then changes that. But we don't see this. So we tend to watch just the nominal rates. The danger in accepting that is saying, well, hang on a second now. All you're doing is you've just moved one step forward and you're ignoring everything on the path. If this is afforded a lot of the responsibility for movements over here, then what we want to pay attention to is not this, but what causes this. And what causes this are things like inflation expectations, risk premium, etc. So there are things that cause this to happen, which then cause this. Anyways, let's look at number one. What are we going to do here? Combat inflation by raising interest rates because we want price stability. We have high inflation. We want price stability. Well, we get there by raising interest rates. So we'll combat inflation by raising interest rates, by lowering the money supply. By lowering the money supply, you take the pressure off of prices. So there's a monetary policy. Well, what's that going to do here? Well, it's going to widen this spread. It's simply going to widen that spread. Number two, policies of lower government debt, financial market liberalization, removal of capital flow restrictions, attraction of foreign direct investment, because not only do we want price stability, we want long-term sustainable growth. So you need all of these things in to get long-term sustainable growth. This is economic and fiscal policies. Well, if what's that going to do to our risk premium at the end? If we start to do all of this stuff, it'll lower the risk of being in this particular country's investments. So this will tighten. If our strategy for number one, combating inflation by raising interest rates, is successful, this should tighten as well. Notice that what's going to happen here with the real exchange rate. This widens, so it puts upward pressure on the real exchange rate. This tightens, and since this is a negative and if this is getting smaller, it puts less downward pressure or upward pressure on the real exchange rate. And if this tightens and it's a negative, then again it should put upward pressure. So high yield, high inflation country following these two principles will expect to see its currency start to appreciate. That is going to be a problem because we know that a very strong currency, what does it do to exports? It tends to be a drag on exports and starts to put exports down. What does it do to imports? It tends to be a boost to imports and starts boosting imports. You end up with a trade deficit. Well, a trade deficit has to be financed somehow. We're talking about lower government debt. That's kind of working against it. So, what's going to happen here? And we're leading into it in one of the sections coming up. We're going to have to either do some kind of currency intervention or some kind of capital control. Because, listen, this country wants financial market liberalization, removal of capital flow restrictions so that they can attract foreign direct investment, but that's going to be an unacceptable consequence of getting to where they want to go. They'd like everything else, but they wouldn't like this to happen. But we know this is going to happen. This typically does happen in most of these situations. Well, how do we deal with that without stepping on any of the work that we've already done? It gets to be a kind of a tricky balance of how do we move forward, right? So here's the conclusion we got to. The combination of monetary, fiscal, and economic policies contribute to continued upward pressure on the exchange rate. Therefore, that lends itself well to carry trade profitability. We're taking high-yield countries, and we're seeing that if they pursue policies of fighting inflation and long-term sustainable growth, which most countries would say, yeah, that's what we're doing, high-yielding countries tend to have their currencies appreciate, not depreciate, as we saw in international parity conditions. And low-yielding countries would tend to see their currencies depreciate and not appreciate. That's what sets up the carry trade profitability. Carry trade profitability is a function of monetary, fiscal, and economic policies. Now, all of these, monetary, fiscal, economic, they proceed gradually. So when there are changes, they are gradual changes, which explains the persistence in the carry trade. It reinforces each other. Each one will reinforce each other, as we have seen, thus produce persistence in carry trade returns. And that's about the best we can get to if somebody asks, how do you make money consistently in currencies, in Forex? carry trade, because there's good economic theory supporting the carry trade, and there is good empirical evidence that says, yes, in fact, this is the case. And we've already seen the use of a volatility filter and of upper and lower bounds on purchasing power parity to eliminate certain currencies that would be at risk of reversing when we're setting up a carry trade. So it seems this whole reading has been almost set up in such a way that it says, okay, listen, Forex is a big playing ground, but you can't play over there and you can't play over there. So rather than starting the chapter with telling you how to play the field, it's basically saying, listen, here's the field, here's where you cannot play. What is left over is where you can play. What is left over is the carry trade. And that seems to be on a serious basis. If you're in the market seriously to make money, you would consider carry trade strategies as opposed to trading in and out of spot exchange rates on a daily basis, playing this currency and that currency. Oh, this one's overvalued, that one's overvalued. We know empirically, not just in a classroom with a professor with a pipe and a sweater saying, well, this is the case. We know empirically by looking in the real world that overvaluation and undervaluation persists for long periods of time, and that overvalued currencies tend to become more overvalued before they become undervalued, and the reverse is true with undervalued currencies. So if we know that all that theory breaks down, well, then we should trade what the theory breaks down on, and that's the carry trade. Equity market trends and exchange rates. Again, we're still with the capital account. So we looked at capital flows. We looked at the idea of the carry trade, all based on interest rate differentials. Equities, well, that's part of the capital account as well. There's capital flows in and out of equity markets in different countries. Can that tell us anything about exchange rates? We don't have a stable relationship there. There's an instability in the correlation. Sometimes you have a positive correlation. Sometimes you have a negative correlation. For example, let me give you two examples of negative correlations. From about 2000, trying to think back now, starting maybe around 2010, 2011, I'm going to draw out the S&P. The S&P looked like this. And during that period of time, the dollar index looked like this. Sort of a negative relationship, that when you had the S&P up, you had the dollar index down. When the U.S. dollar index went up, the S&P went down. I could tell just by looking at the dollar index where the futures were that morning. I didn't need to look at the S&P futures and the dollar index. I could just look at the U.S. dollar index. If it was negative, S&P futures were positive. If it was positive, S&P futures were negative. Now, why that relationship, and this is why. It was still a very precarious period of time, and the euro crisis was really just beginning to unfold. We hadn't had a lot of the problems. There was just some worry about Greece coming up. There was a period where you had that flash crash where things went very badly. I think it was in May where the market dropped 1,000 points. We were still leading up to the problem of Greece. There seemed to be a financial summit in Greece, in Europe, every 2 weeks. I think I counted like 18 or 19 financial summits, and still nothing out of it. But what was happening at that period of time is when the market got scared, it ran to the U.S. dollar. Money ran to the U.S. dollar from everywhere, even U.S. equities. So when there was more risk in the world, the U.S. dollar rose, but all risky assets dropped, including U.S. equities. Whenever the ECB announced a new financial summit, then it'll be fixed this time. It's the 14th meeting they're having, and you know what everyone says, 14 times is the charm, right? If it doesn't work 13 times, try it the 14th time. That'll work. And so it would rally, the euro would rally, the U.S. dollar would sell off, its risk on, and the markets were back up again. So it's hard to tear apart this relationship when you have one of the elements being a reserve currency. A more realistic event happened I'd say from about 2012 to about 2015. Or is it 2000? No, 2013, starting, I believe, in November or December of 2012, late in 2012, leading into 2013. The U.S. yen pair, U.S. dot yen, was about 80 at that period of time, and the Nikkei index, NIKKIE, was sitting around 15.8 to 16, well, running around 15.8 to 16.4 in around that period of time. And let me just get rid of this so I have a little bit more room to tell this story. Well, we'll leave that there and we'll just get rid of this. So here's the Nikkei. Here will be the yen, JPY, and here's the index. And the yen went from about 80 to about 120 over a period of about a year and a half. They just continued to drive that currency lower against the U.S. dollar. Now you're wondering, well, why are you drawing an upward line? Because that's the yen, right? So the U.S. dollar was able to buy 80 yen. At the end of the period of time, the U.S. dollar was now buying 120 yen. So the yen really depreciated against the U.S. dollar. At the same time, the index went from 16,000 to 20,000 over that period of time. So there was a very tight correlation between the equity index and the exchange rate. So sometimes you do have a relationship. Other times you do not. When we're looking at equity markets, so I say it's not a stable relationship. There's an instability in the correlation. Makes it difficult to form judgments on possible future currency moves based solely on expected equity market performance. Well, we're on to our next learning objective, LOSK. Keywords here, explain. No calculate, so that's nice. Explain the potential effects of monetary and fiscal policy on exchange rates, and the keyword there is the potential effects. Now, in the last learning objective, we credited the nominal interest rate differential between two countries as being the primary determinant of short-run oscillations of an exchange rate around its long-term equilibrium. But I also said that there are things that cause that interest rate differential. Primarily, monetary, economic, and fiscal policies in a particular country will give us some indication of where those interest rates might be headed. So this is what we're doing in this particular learning objective, or this particular series of learning objectives, KLNM, is stepping back one step and saying, okay, well, let's look at these monetary and fiscal policies and let's see if we can't determine the line of causation from changes there to changes in the nominal interest rate to changes in the exchange rate, which is what we're doing. So we'll start with the Mundell-Fleming model, and this is so basic. It's really just a narrative model. It's not a mathematical model. But let's look at expansionary monetary policy and expansionary fiscal policy. And when we talk about expansionary, we're really saying the intention here is to increase aggregate demand and increase output. So we'll start with monetary policy, expansionary monetary policy. Well, reduce interest rates. When you reduce interest rates, you make large capital purchases easier to make. It boosts home prices. It increases the selling of vehicles, anything durable goods that require financing. It makes financing cheaper, right? Reducing interest rates increases aggregate demand. Increase investment and consumption spending. Increase investment spending simply because, well, when we buy a house, we invest in a house. Companies may decide that now it's time to add capacity to factories because their borrowing costs are lower. So it'll increase investment and consumption spending. Leads to capital outflows. Well, lower interest rates, lower return on the currency, capital will then seek a higher return somewhere else. So it leads to capital outflows and puts downward pressure on currency rates. Let's look at expansionary fiscal policy. Increase spending or lower taxes. Either the government can say we'll spend the money, or they can say, you know what, the consumer's smarter. Let's leave the money in their hands and let them spend the money. There, the market mechanism is working just nicely, right? So they can increase spending or lower taxes. Exerts upward pressure on interest rates. So that kind of works against an expansionary monetary policy. When we have an expansionary fiscal policy, exerts upward pressure on interest rates through larger deficits that need to be financed. So larger deficits need to be financed, more debt, more risk. You need higher interest rates to compensate for that. Now, that is not a linear relationship, by the way. It's not linear at all. In fact, for within some band of debt, there is no pressure at all on interest rates because of this. Only at certain levels of debt, by pursuing even more expansionary fiscal policy, would it then start to put upward pressure on interest rates. Only then would it start to do that. So there's a large band in there up to a certain threshold that a country can play within, where it does not necessarily put upward pressure on interest rates. But this was developed in the 60s with very simple thinking at that time, so let's just go with it. Let's say, okay, fine, exerts upward pressure on interest rates, leads to capital inflows, which then puts upward pressure on exchange rates. So we can see that if a central bank pursues expansionary monetary policy and we have expansionary fiscal policy, they kind of counteract each other. One will put downward pressure on exchange rates, the other puts upward pressure on exchange rates. So what happens to the exchange rate, we really don't know. One will lower interest rates, the other tends to exert upward pressure on interest rates. Maybe they offset each other, maybe there's a battle in there, maybe they're not coordinating their activities well enough. But this one here, again, that's a little bit questionable, especially for very well-developed countries. The more responsive capital flows are to interest rate differentials, because each of them will have some effect on the interest rate, the more responsive capital flows are, the larger the depreciation or the larger the appreciation. Here, under monetary policy, we're saying the larger the depreciation, and here under fiscal policy, we're saying the larger the appreciation, because we're saying that expansionary monetary policy will put downward pressure on currency rates, on exchange rates. The more responsive capital flows are to interest rate differentials, the larger that depreciation will be. And here, since it put upward pressure on exchange rates, the more responsive capital flows are, the larger the appreciation. Now we're going to go into a scenario where we say, well, what if capital flows are not that responsive? What happens then? And we'll talk about that shortly. As by the way, as the currency is depreciating, larger the depreciation, this eventually begins to boost net exports. Simply because the relative price of our exports on a global basis, if we're the country in question, keeps getting cheaper. But for our own consumers, the lower the currency goes, the more expensive imports are on a relative basis. All right. What about a case where we have fixed currency rates, where a country doesn't allow its currency to fluctuate? So we don't have depreciation or appreciation in the rate. We have fixed rates. What happens now? Well, under an expansionary monetary policy, the central bank will have to buy its own currency and deplete its foreign reserves to support the currency. So to support a currency, you have to buy it. There has to be some buying to push prices up, right? So it will have to start buying its own currency. To do that, it will have to sell its reserves, its foreign reserves, to buy back its own currency. This strategy is limited by the stock of reserves. Once you run out of reserves, well, that's the most you can do to support your currency. So if you have very small reserves as a percentage of all of the money supply, that's not going to work for very long. If you have very large reserves as a percentage of the money supply, you may be able to do it for a while. This tightens domestic credit conditions. Now, how do we make the move from, wait a minute here, if the central bank is supporting its currency by buying back its own currency, how does it tighten domestic credit conditions? Well, somebody's hanging on to money, right? Money is either available to float freely in the economy for the exchange of goods and services, or it's held. If the central bank is buying back the currency and selling off its foreign reserves, that currency now that was available is no longer available. So it actually decreases the amount of free-floating money supply that's out there to buy goods and services. So it does tighten credit conditions, which offsets the intended expansionary policy. So a central bank with a fixed exchange rate regime that tends to lower interest rates to encourage demand will have to then support its currency, because that kind of activity would put downward pressure on its currency, thereby restricting the very thing that they were trying to expand. Let's look at it in terms of fiscal policy. The central bank will have to sell its currency and build reserves. Why? Because, recall, fiscal policy, expansionary fiscal policy, will tend to put upward pressure on interest rates because it has to finance increasing deficits, will tend to put upward pressure on the exchange rate. So to keep the exchange rate down for a fixed rate, you've got to sell your currency and you will build reserves. Theoretically, you can do this forever. You could just keep printing money, keep creating money, and selling it and buying reserves. So you theoretically could do this unlimited. I say theoretically, because practically there's a limit to doing that, but theoretically you could. This expands the domestic money supply, because now you're creating money, you're selling money, which means you're pushing money into the economy. It expands the domestic money supply and reinforces the expansionary policy. So this kind of works, it doesn't counteract itself, it kind of works in the same direction, but again, this is theoretically unlimited, but practically there are problems with having to do this. All right, let's sum up the Mundell-Fleming model, and let's look at some key points here. There are two key points, they're sort of related. Key point number one is all of this over here. If domestic policymakers try to pursue independent monetary policy, what do we mean by independent monetary policy? Let's be clear. That means that the central bank will pursue its mandate. If it's price stability and full employment, if it has a dual mandate, that's what it's going to do, regardless of anything that's going on around it. It's not going to let the exchange rate dictate what it's going to do. But if it has to deal with the exchange rate, then suddenly the monetary policy is not independent of their mandate. But if they try to pursue independent monetary policy, if they permit capital to flow freely across national borders and attempt to defend their currency rate, all three cannot be satisfied at the same time. So if you had to do all three, which one is the most likely one that you'd say, well, we can do without this? Independent monetary policy, defending your currency, or permitting capital to flow freely? If you eliminate B, you can do A and C. You don't have to worry too much about it, and that's typically what is done. That's one of the conclusions from this model, is that it will lead to capital controls may need to be imposed to satisfy A and C. So let's look at two particular examples. One will look at high capital mobility, and the other will look at low capital mobility. We'll assume that capital controls are already in place. So here is high capital mobility, and we've looked at, we're going to look at monetary policy, either expansionary or restrictive, and fiscal policy, either expansionary or restrictive. And we'll start with the two opposing boxes over here. An expansionary fiscal policy means that the government is spending more money. Remember, we said that puts upward pressure on interest rates. A restrictive monetary policy means that the central bank is raising interest rates. So under both these conditions, interest rates are going up. It attracts capital flows. And remember, high capital mobility, right? So it attracts capital flows. Domestic currency appreciates. Let's look down here. Restrictive fiscal policy, that's austerity, along with expansionary monetary policy. And expansionary monetary policy is either keeping rates below normal levels, very low levels for extended period of time, or quantitative easing. Let's look at this top corner here. Expansionary fiscal policy, expansionary monetary policy, and the conclusion on the exchange rate, ambiguous. All right, let's go to the other side here. This was high capital mobility. Let's say now we have low capital mobility, and let's do it again. And notice that we had the diagonal here that we could pretty much fill in. Well, this works in the opposite way. Now, here's the deal. We can't look at capital flows to determine what's going to happen to the exchange rate. We have to look at trade flows. The effects of when we have low capital mobility, the effects of changes in the interest rate primarily operate through trade flows. So let's see if we can't fill in the logic on that one. Let's take an expansionary fiscal policy, and let's take an expansionary monetary policy. So what happens in an expansionary monetary policy? Now we're really just looking at trade flow, so we have to look at the effect on aggregate demand. We can't look at the interest rate and then look at the exchange rate because we have low capital mobility. The interest rate differential is not going to do anything. If we want to look at what happens to the exchange rate, we got to follow a different path. So now we're going to follow the path from expansionary monetary policy to aggregate demand to trade and then to the exchange rate. So if we have expansionary monetary policy, we're boosting aggregate demand. Well, when you boost aggregate demand, you can't tell your citizens to pick just domestic goods or foreign goods. You can't ask them to do anything at all. So what's going to happen is your trade balance is probably going to deteriorate. Expansionary fiscal policy. Well, that's the same thing. What are you doing? You're actually increasing the amount of aggregate demand. When you increase aggregate demand, your own consumers are not exporters. If they consume anything, anything they consume is either domestic or it's imported. So all it's going to do is it's going to raise aggregate demand, and if it raises aggregate demand, it's going to raise aggregate demand for both the domestic product and the imported products. So imports are going to increase. Under both of these scenarios, imports are going to increase. However, externally, exports are not necessarily going to increase, simply because other countries are not subject to our domestic expansionary monetary policy and fiscal policy. So it's going to have no effect on our exports, but because it raises aggregate demand, and demand will either be of domestic products or imported products, and if consumers don't change the mix of the products they buy, they just buy more of it, they'll buy more imports, it will actually increase or decrease the trade balance. So if we have a trade surplus, it'll bring it down. If we have a trade deficit, it'll make it worse. The trade balance depreciates. If the trade balance depreciates, the domestic currency depreciates. Let's look at the other side and see if we can't find the logic there. A restrictive fiscal policy. There we're lowering aggregate demand, and if we lower aggregate demand, there's less being bought. And consumers have a choice between buying domestic goods or imported goods, and if there's less being bought, they'll probably buy less imported goods as well, so imports should drop. A restrictive monetary policy is meant to lower aggregate demand as well. Same argument, imports should drop. Well, if our imports drop, what about our exports? Again, externally, in the external world, our domestic monetary and fiscal policy should have no effect on our exports because externally that demand is unaffected by our policies. So exports should remain the same. So if exports remain the same and imports drop, our trade balance improves, the domestic currency appreciates. So where we had ambiguous activity before, we now have something to say. In markets with low capital mobility, we have to trace it through the trade flow. So we go from the policy to aggregate demand to the trade balance to the exchange rate. Here we go from the policy to the interest rate to capital flows to the exchange rate. All right, we're going to move on to the next approach, the monetary approach. And in the just to recap, the Mundell-Fleming approach, considered monetary policy, fiscal policy, economic policy. It was really looking at expansionary policies versus restrictive policies. And its course of action was from the policy to the interest rate, and from the interest rate to the exchange rate. When we look at just pure monetary approaches, monetary policy affects the price level or the rate of inflation, which then affects the exchange rate. So it doesn't run through the interest rate, it runs through the rate of inflation, because central banks usually have a mandate of price stability, and they use the interest rate to achieve that, as opposed to interest rate targeting. They have inflation rate targeting. So, as per the quantity theory of money, money supply changes are the primary determinant of price level changes. This is the monetarist perspective. To describe inflation is that everywhere inflation is a monetary phenomena. And there's I forget the title of the book, The History of something or other, Milton Friedman, and I believe it was Anna Schwartzman. 1973, looked at economic conditions over a long period of time in the U.S. and found that periods of rapid money supply growth were also periods of rapid price inflation. So money supply changes are the primary determinant of price level changes. Monetary policy affects the level of money supply, so keep your eye on this, and then we can determine or use this to determine what the likely effect on the exchange rate is. Assuming purchasing power parity holds, that's a big assumption here, assuming that it holds, a money supply-induced increase in domestic price levels relative to foreign prices should lead to a proportional decline in the domestic currency's value. And the argument follows along this route, and I'll see if I can write it out for you, in line with the model we used earlier for the real interest rate, which was QFD. We knew was equal, the oscillations in the real interest rate, or the real exchange rate, oscillated around its long-term equilibrium value. Well, because we're assuming purchasing power parity, we're assuming that the real exchange rate is unchanged. It never changes, so that it is equal to its long-term equilibrium rate. Thus, an increase in the money supply will lead to an increase in the price level. And I'm just going to call that CPI, even though I know that's inflation. Just treat it as the price level. Leads to an increase in the price level. And an increase in the price level, given that the real exchange rate is going to stay the same, leads to a decrease in the nominal exchange rate. So basically, that's the transmission from monetary policy to the exchange rate is through the price level. The shortcoming of the monetary approach, of the general monetary approach here, is the assumption of PPP holding at all times, and we know that in the short to intermediate term, that's not really drawn out in observation. Therefore, the monetary approach may not realistically explain policy effects on the exchange rate over those periods of time. So we then move, within the monetary approach, we move to the Dornbusch overshooting model. Prices exhibit limited flexibility in the short run, but fully flexible in the long run. So remember, we said that an increase in the money supply will lead to an increase in the general price level. I'll just call it P so we get that, which because real exchange rates are constant and equal to their long-term equilibrium value, will lead to a decrease in the nominal exchange rate. In the long run, that's a true statement. Increase in the money supply, increase in the price level leads to a decrease in the long-term rate. I know I'm putting CPI in there in terms of being measured as a rate of inflation, but just I'm substituting it in as just the general price level altogether. The short run, though, increases in the money supply have very little effect on the price level, because prices tend to be fixed over periods of time. They're called menu prices or sticky prices. Wages don't adjust on a daily basis. Prices don't adjust. Typically, if prices adjust, it's every 6 months or every year. Not only that, a lot of prices are under long-term contracts, so they don't adjust that quickly. So in the short to intermediate term, the mechanism flowing from a policy change to a price level change sort of gets stuck there. That's why we say this is the monetary approach with somewhat flexible prices. So if this is the case, and the CPI or the price level doesn't respond right away, we have an increase in the real money supply. In the previous model that we've just got through, assuming purchasing power parity does hold and that prices are responsive, the real money supply and the real exchange rate stayed constant. Here we have an increase in the real money supply, which will then lead to a decrease in the domestic interest rate. A decrease in the domestic interest rate, what do we get? You get capital outflow. Therefore, the rate, the exchange rate, will drop, but it overshoots on a short-term basis. That's why it's called the overshooting model. If prices adjusted quickly, you would not have the increase in the real money supply. So the exchange rate would still drop, but it would drop in line with the price increase, proportional to it. or proportional to the increase in the money supply, whichever way you want to look at it. But here, because prices are inflexible, the rate will overshoot on a short-run basis. So we've looked at the Mundell-Fleming approach. We've looked at the monetary approach and LOSK. And then now says, and the asset market, or the portfolio balance approach. And this takes the perspective from fiscal policy as opposed to monetary policy. It just breaks out fiscal policy on its own. So let's have a look. Mundell-Fleming model is a short-run model of exchange rate determination. It basically just has a mechanism that says if this happens, then the exchange rate happens. It doesn't give a time frame. It just sort of suggests that these are the sequence of events. That there'll be an adjustment in the near term as opposed to just the long term. It makes no allowance for long-term effects of budgetary imbalances that typically arise from fiscal policy actions. In fact, it doesn't say anything about that. It just talks about the immediate consequence of a fiscal policy action as opposed to looking at the accumulated fiscal policy responses and the accumulated deficits and debt that build up and say, well, listen now, if fiscal policy goes any further, it's not going to be a positive for the currency. It's going to start to be a negative for the currency. So the portfolio balance approach fixes that little shortcoming. And basically, it makes some assumptions here. Number one, global investors hold diversified portfolios of domestic and foreign assets, so that a steady increase in the supply of domestic bonds or of foreign bonds from a particular country, it doesn't have to be the domestic bonds, but we'll just pick on whatever country we want, the domestic country here. A steady increase in the supply of domestic bonds outstanding, in other words, widening deficits, widening debt. I know a deficit is only for the year and the debt is the accumulation of it, but it's a widening deficit over a period of time, or building debt. An increase in the supply of domestic bonds outstanding will be willingly held only if holders are compensated with higher expected return, because each additional bond that's issued is on top of everything else. So it's the riskiest bond that's being issued, right? It gets riskier and riskier to hold those bonds. So they need to be compensated with higher expected return, either with higher interest rates or a depreciation of the currency to a level sufficient to generate an anticipation of gains from subsequent appreciation. So to get a good idea of the fiscal policy, the exchange rate response to fiscal policy action, we can combine the MF, the Mundell-Fleming approach, and the portfolio balance approach. And let's say that we're undertaking expansive fiscal policy. Short-run response, as per Mundell-Fleming, increase in the real interest rate differential, currency appreciates. Long-run response, government debt builds up. And one of two things can happen, or both can happen, is the central bank monetizes the debt. And let's be clear what we mean. We throw these words around sometimes. We hear monetized debt, but we're not sure, well, what do you mean by monetized debt? It means the central bank buys government debt with newly created money. That's called monetizing debt. So when we look at quantitative easing, if that is done through a central bank by creating new money, well, that's monetizing debt. The fiscal stance turns restrictive. The government has to say, look, we can't keep spending. There's many governments that are in a lot of debt embark on periods of austerity where they got to cut to get back in line. Both of these actions lead to a currency depreciating. So while the Mundell-Fleming model looks at the fiscal policy on its own at that point in time and says, this is the path, increase in the real interest rate differential and the currency appreciates. In the long run, it doesn't consider this aspect. This is what we've done in the third part of this learning objective, which is the asset market or the portfolio balance approach. Is this government debt buildup can turn negative and actually weigh down the currency. All right, we're on our next learning objective. Describe objectives of central bank intervention and capital controls, and describe the effectiveness of intervention and capital controls. So, what is the objective of intervention and capital controls? Well, it's to protect the external value of the currency. So let's have a look at a situation here. Let's take a domestic economy and a foreign economy. The book likes to talk about developed markets versus emerging markets, and saying that the emerging markets are facing this. I'm just going to say domestic versus foreign economy, and we can go from there. There may be forces in a domestic economy that is pushing capital out of its market, and there may be forces in a foreign economy that is pulling capital into its market. So capital flows can respond to being attracted to something or being repulsed by something. So what pushes capital out of a particular economy? Greater global allocation among portfolio managers of the money assets under management. Low interest rates. Let me just expand on this one here without leaving it right away. As the financial markets become more globally integrated, it's becoming easier and easier with very low transaction costs to take a global perspective in your portfolio, so that you're not all in domestic assets. So as each year goes by, a greater and greater number of portfolio managers and a greater percentage of the assets begin to reflect more of a global composition. Well, that will move money around the world. That will create capital flows on its own. What pulls money into a particular economy? High interest rates, high short-term rates, flexible currency exchange rates, and low debt levels, among other things. There's a lot of other things. I've just listed 3 here. Well, this can become a bit of a problem. You have high interest rates in this particular country. It's attracting capital, but in attracting capital, it can have some negative consequences. It can push your exchange rate up to an overvalued level, way beyond where you want it to be, which actually starts to hurt perhaps your exporting sector. It can create asset bubbles, which, when the party's over, those things crash. To avoid excessive surges of capital inflows, typically followed by huge outflows, the use of either capital controls or currency market intervention. And what do we mean when we talk about currency market intervention? We're not talking about specific policy actions like raising or lowering interest rates. We're talking about actually stepping into the market and buying or selling the currency to either support it or push it down, to bring it down from an overvalued level or to bring it up from an undervalued level. So it's actual direct intervention in the market. And we've already sort of alluded to this earlier, that if a currency is overvalued, how do we get it down? You've got to sell that currency. So a central bank will sell its own currency and build up reserves. And by selling currencies, what is it doing? It is increasing the money supply. It is increasing. So if we have an overvalued currency because of capital flowing into an economy, and you already have high rates, you're probably already dealing with a high level of inflation. If you start increasing the money supply, you'll also increase inflation. And if we have an undervalued currency, the opposite. So what I just said, just flip it around. So let's look at intervention as per the IMF guidelines. IMF says, yeah, you can intervene, but here's how you should do it. Number 1, if you have an undervalued currency to begin with, and this is going on, and your currency starts appreciating, if it's undervalued to begin with, do not intervene. Let it go. It's already undervalued. If you have a fairly valued or a somewhat overvalued currency, and you're worried about these capital inflows, and there is no inflation threat, then use what is called unsterilized intervention. Unsterilized intervention means you intervene to push down the value of your currency, and there you go. That's all you need to do. Doing the intervention, as we said, will expand the money supply. That will increase. But since there's no inflation threat, we don't have to worry about that. It will cause rates to move lower, which will slow down capital inflows. And number 3, if you have a fairly or overvalued currency, but inflation is a threat, then you engage in sterilized intervention. You still sell your currency to push the value of the currency down. So you're solving that problem. You're going to intervene. You're going to sell your dollars. You're going to build up foreign reserves. But now you have an increased money supply, which has a bit of a problem because inflation's already a threat. You will sell domestic securities to the private sector. So they will hold on to those securities, and you'll pull that money out of the system, thereby reducing the increase in the money supply that you created, hence sterilizing that intervention. It mops up excess liquidity created by the intervention. So you'll end up with, hopefully, a balanced money supply, no increase in the money supply because the securities you place in the market should mop up that liquidity. And hopefully the intervention worked well enough that you lowered your exchange rate. Number 4, if there is a limit to sterilization, then tighten fiscal policy to slow down domestic demand. If you slow down domestic demand, you take some pressure off the inflation rate. If you do that, you take some pressure off the central bank to keep rates high. They can begin to lower rates. Does this stuff work? What's the effectiveness of it? For developed economies, the effect is statistically insignificant. The effect is statistically insignificant. For emerging economies, it contributes to lower forex volatility, lower exchange rate volatility, but no statistical significant effect on the level of the exchange rate. So you'll have lower volatility, but no effect on the level. And that makes sense, because if you got a currency that's pushing up and you try to push it down, you'll intervene, but then it'll start to come back up again on its own, because the market will jump right back in after the intervention. You'll push it down again. You'll get a pattern that starts to look like this. So you'll get lower volatility, as opposed to it continuing up and then significantly dropping when they decide the party's over. So you'll lower the volatility in the exchange rate, but no significant effect on the level. So intervention doesn't seem to work, and it really doesn't. I've seen at least a dozen interventions from different central banks. From even Canada did it back in the 90s. It intervened once in the market. The Swiss National Bank intervened. Japan intervened. I've seen it done. And here's what happens: if the market knows that there's going to be intervention at a particular point in time or over a period of time, they know that's going to end, and they're going to come right back. Sustained long-term intervention, the Swiss National Bank tried that and then finally gave up. Japan is currently doing that now. So it really depends on the political will to continue to do it. But they all have limits to how far you can go. And that's known, that once the intervention is over, it's over. It's like a company buying back its own stock, creating the demand for its stock by buying back its own stock. Once it finishes the buyback, that demand for the stock disappears. So if they were buying back their stock to support price in the marketplace, all they're doing is creating the demand. They're not inducing confidence in anyone else to do it. They're just creating that demand, and it goes away. So intervention doesn't really work. It's a short-term fix. You can't intervene your way to a solution. You can intervene your way to more time to find an underlying solution, but the intervention itself is not a solution. It's a Band-Aid on a cut that's not going to heal. It just stops us from looking at the ugliness for a while. What about capital controls? Mixed. Whether capital controls worked or not, mixed. The more persistent the inflows, the larger their magnitude, the less likely capital controls will work. The less likely capital controls will work. So, not very satisfying in terms of intervention or capital controls. If you're on the other side, if you're on the side that says, well, I don't like the value of my currency, I got to do something. The empirical record of its effectiveness, it's not very good. All right, describe warning signs of a currency crisis. And there's been a number of papers written on this and a number of books written on this. I think the one that I particularly enjoyed was written by, I think it was Kindleberger, Manias, Panics, and Crashes. I thought was really interesting. It's written not in an academic way, a very accessible way, Manias, Panics, and Crashes. And I thought it wasn't as rigorous as an academic would like if an academic were reading a book, but even though I'm an academic, I'm more of a pracademic. I live more in the practical world. I like someone to talk to me in a practical sense by looking at, hey, what did happen, and tell me about it. I thought it was a good book. Not a great book, it's not at the top of my list. It's certainly not a Black Swan or Traders, Guns, and Money or Confessions of a Wall Street Analyst, but it would be a second-tier book. If I had to do, like a list of 50, it would make the top 50, but in the lower 25. Books about this particular topic, not all-time books. Okay, let's go on here. By the way, if you want to know what my all-time favorite book is of all books that have ever been written, Thus Spoke Zarathustra by Nietzsche. So if you're interested in Nietzsche, read that one. All right, number one, currency crisis warning signs. The first one, the real exchange rate substantially higher than its mean level during tranquil periods. Forex reserves decline precipitously as the crisis approaches. Some deterioration in the terms of trade. And the terms of trade is the ratio of export prices to import prices. So there's some deterioration in the terms of trade. CPI significantly higher pre-crisis versus tranquil periods. So you have high levels of inflation. The ratio of money supply to bank reserves tends to rise in the 24-month period leading up to the crisis. So you have either an expanding money supply or lower and lower reserves that are required. Broad money growth, nominal and real, rises sharply in the 2 years leading up to the crisis. Number 7, nominal private credit growth rises sharply pre-crisis. You have a boom in credit. I would have put that as number 1 as a warning sign, because that always seems to be there as this credit binge. Well, that can't last forever. At some point at the margin, someone is going to say, why would I lend money to anybody at this point? Everybody is so in debt that this is the next loan is the loan that breaks the camel's back here. I'm not going to do it. So you get to some point where credit availability, the willingness to lend, disappears, and that's the end of it. And that's the end of it, because if you got an economy where households are highly indebted, they usually roll their debt over. So after they get a 5-year mortgage in 5 years, they haven't paid off their mortgage. That was 5 years of a 25. They got to remortgage. Well, if they're so indebted, they're not going to be able to roll that over. That's the end of it. I would say that's a big one. I don't know why they put it at the bottom of the list, but there it is. And typically some form of equity market boom just before the crisis, because all that money's flowing into the country. The index is going up. Even citizens in that particular country that are subject to the boom start to get involved. You know, and like the old saying goes, when your cab driver starts giving you stock tips, it's time to sell, because that means that everybody's in. The only way prices can go higher is if more people come into the market, and if everybody's in, it's time to get out before everyone else decides to get out. So these are some currency crisis warning signs. There are, I think, more realistic ones that we can look at that aren't so technical or so detailed or rely on so much on, especially when we look at number 5 and number 6 tends to rise in the 24-month period. Both of these are either a 24-month period or the 2 years leading up to a crisis. That's a long period of time to be watching something. And again, well, how far does it go? At what levels do you start to get concerned? At what levels does anybody get concerned? No politician wants to slow down a party, especially if it's an election cycle or an election year. So maybe you're in that period of time. It's an election year. Who wants to shut it down? Nobody wants to shut it down, which is typically why these things end badly, is because nobody decides, okay, it's time to turn down the music. Everybody settle down. Let's start filing out nice, single file. It usually means the cops are showing up and everybody's running. And that's typically why it's called a crisis. So if you study crisis, what you're studying is people fleeing from the party because the cops showed up. Otherwise, it wouldn't be called a crisis. What you'd like to study is all the crises that never became crisis. But how do you find them, right? What signs indicate to you that, hey, look, this would have been a crisis except for all the things that were done. So when we see a crisis not happening, then you say, well, is that because they averted a crisis or because there was nothing there? So I don't know that studying crises helps, because the only way you get a crisis is if nothing happened, if nobody did anything and it actually ended up being a crisis. I don't know if you can follow that logic, but in my head it makes a lot of sense.